Good morning, ladies and gentlemen. Welcome you today to the Bengal Chamber premises, heritage premises that we have here in Dalhousie, Kolkata. We have all gathered today for an in-depth analysis of the Union Budget, which was presented yesterday by Honorable Finance Minister Srimati Nirmala Sitharaman. This incidentally is the last full budget before the Union parliamentary elections. So whether or not it has fulfilled expectations of the industry, of the individuals, across sectors, that we'll dissect, discuss and deliberate on today. Without further ado, I would like to start today's proceedings. We have with us today Mr. Shubhit Chakraborty, President, the Bengal Chamber of Commerce and Industry and Managing Director and CEO, Exide Industries Limited. I would request sir to please come up on the dais. Next, we have with us virtually Mr. Dinesh Kanabar, the CEO of Dhruva Advisors LLP. Dhruva Advisors LLP and Bengal Chamber of Commerce and Industry in collaboration is bringing to you this in-depth analysis session of the Union Budget 23-24. Mr. Kanabar, if you can hear us.
Yes, I can. Thank you.
Good morning. Mr. Kanabar has joined us from Mumbai. And also we have with us a very eminent economist and Chairman 5th State Finance Commission, West Bengal, Professor Dr. Obirup Sarkar. Sir, if I can kindly request you to come up on the dais. Thank you. So from CAPEX, unprecedented CAPEX outlay to income tax, new income tax regime to unprecedented outlay for railway, infrastructure push, we have seen everything yesterday. Now we need to understand from the experts whether or not it has lived up to expectations of the industries and whether it will spur growth of the nation in expected lines. So I would request Shubhit Chakraborty sir, President, Bengal Chamber of Commerce and Industry and Managing Director and CEO, Exide Industries Limited, to kindly present the Chamber's overview on Union Budget 23-24. Sir.
Mr. Dinesh Kanabar, CEO, Dhruva Advisors LLP. Professor Dr. Obirup Sarkar, eminent economist and Chairman, 5th State Finance Commission, West Bengal. And friends, on behalf of Bengal Chamber of Commerce and Industry, I heartily welcome you to this very meaningful seminar on discussion on the budget, which was presented yesterday by the Honorable Finance Minister, Mrs. Nirmala Sitharaman. And I'm sure, as with any budget speech, this leaves a lot of questions in the minds of the various citizens of the country. And people are eager at this point of time to understand the fine print, understand the nitty-gritties, understand the implications for the individual or for the individuals who are owning businesses. So, I come from the world of business and I like to see things in black and white, unlike economists who also explore the gray areas. So for me, what does this budget mean? What is the government trying to do? I think the government has done one very good thing. It has laid out the Saptarishi policies or the pillars on which this budget is based. The pillars are inclusive development, reaching the last mile, infrastructure and investment, unleashing the potential, green growth, youth power and financial sector. So these are the 7 pillars on which the budget stands. So what is the government trying to tell us or trying to convey to the citizens of this country? What the government is trying to tell us, to me, in my opinion, is that I kickstart the investment for you. What is this investment? This is huge 33.5% growth in the capex outlay, in the public expenditure. What will it do for you? It is going to, in turn, kickstart private capex, private investment. It will create jobs in the economy. It will be good for you. So, while the government has initiated this capex initiative, there is a hope that around this capex initiative of the government, the private sector will also follow suit. What else is it trying to do? To my mind, apart from this, it is also trying to make life a little bit easier for the middle class through the tax tweaks. Now, how does that help? That's obvious. You have more money in your hands. If you have more disposable income, you tend to spend more on consumer goods, on consumer durables, which in turn will encourage the private sector to invest more in their capex. So this is something, while you kickstart investment, you also try to take care of the demand side, and hopefully that will work. Third thing I think the government is trying to do here, it is trying to reach the last mile, the disadvantaged sections, empowerment of women, the social sectors. So it is also trying to take care of that through various schemes. So in all, I think, to my mind, this budget has got two characteristics. One is wholesomeness, the other one is inclusivity. This is broadly the theme, to my mind, on which this budget is based. Of course, at the individual level, one would have liked to see certain more things, and depending on where that person is coming from, what kind of business is heading, or what kind of profession is engaged in, he would obviously have wanted something more. Additionally, apart from these three things, I think another important thing that this government has also conveyed very boldly is the green growth and the green mission. So when our Honorable Prime Minister talked about this at the COP meeting held at Glasgow, there were some views or some thoughts that whether this was attainable or not, whether this is too high an ambition, how will we do it, what's the roadmap. I think the government is systematically moving towards that aspiration or ambition through encouraging the green economy, and now it has come down to specifics, which is a good thing. It is talking about hydrogen, talking about lithium. So that, I think, is an encouraging sign for all of us, because cleaner air, cleaner water benefits all of us. So this, to my mind, is the summary of what I have understood. I am sure that is far from a complete understanding, and I will be very eager to hear the views of the expert panel here in order to develop my own understanding on the subject. So once again, a warm welcome to all of you. Thank you very much.
Thank you, sir. We have with us Mr. Dinesh Kanabar. Mr. Kanabar, if you can hear us.
Yes, I can hear you, and I hope you can likewise.
Yes, we can. I'd request the AV team to kindly project Mr. Kanabar. Yes. So, sir, would request your comments on the Union Budget 23-24, please, for our audiences. Thank you.
Thank you. Thank you for asking Dhruva to host this presentation on the Union Budget 22-23 and on the Finance Bill 23. Quite a few changes have come about, and at a macro level, as was mentioned earlier, We have the entire thrust on capital expenditure. A couple of things which got mentioned yesterday and which I have not seen being spoken about a lot, but which I thought are very interesting, very relevant, I would just like to table. One is the entire issue on arbitration with the government. So the finance minister mentioned in her speech that she is setting up sort of a committee to look into issues where there are disputes between the government and private sector or intergovernment departments, and we sort of a settlement scheme, a Vivad se Vishwas as she called it. And of course, one has to see the contours of whatever this means, but we are all aware as to how, particularly in the case of infrastructure projects, there are lots of disputes on monies recoverable, extensions, etc., etc. And if this settlement scheme can provide a resolution of the dispute, that would be something very, very welcome. The decision to introduce digitization, to introduce computerization in ports again will be very, very welcome. Some of these provisions, of course, will depend on how they get implemented. On the tax front, while my colleagues will take you in depth on the provisions that have been proposed, I see a very, very, very distinct trend, and I would not like to lose sight of this trend. And let me just share these thoughts with you. So the one thing that the government has come back to say is that we are not going to permit any abuse of the law, any smart interpretation of the law. And let me try and tell you what I mean by that. So for example, for long there has been this whole question that if you earn capital gains and the asset has not cost you anything, is it taxable at all? So there was a Supreme Court judgment many decades ago which sort of held forth to say that an asset whose cost of acquisition cannot be ascertained or is nil, you can't compute capital gains. That was a very technical proposition. And then the law got amended from time to time to say certain assets will be included, etc. But the litigation continued as to what is covered and what is not covered. And now the law is being amended to provide that any asset, if it has not cost you anything, there is no cost of improvement, the cost will be treated as nil and you will have to pay tax on the entire gains that you make. And absolutely makes eminent sense. You know, for us as tax advisors, we keep on spending hours and hours advising clients on issues like that. Or take, for example, what is happening on market-linked debentures, MLDs. We are all aware that when a company issues debentures, those are normally traded at par. However, the proposition was that if I list my debentures and there is an appreciation in value, which we'll all agree is only on account of inbuilt interest, then because these debentures are listed and they are listed for more than a year, the gains will be regarded as long-term capital gains taxable at 10%. And the law is now being amended to provide that any such gain will be treated as short-term capital gain, which again is very reasonable whether we like it or not, to go back and say that this is interest which otherwise would have been fully taxable. You cannot keep on sort of putting structures and convert what is essentially a capital gain or what is essentially interest into a capital gain. So the message seems to be loud and clear that we will not permit sort of fiddling around with law. What is required to be taxed will be taxed. I'll take one more example, the issue which has become a matter of hot debate, which is on the insurance payment. So the proposition now is that if you have an insurance policy on which your annual aggregate premium is more than 5 lakhs of rupees, then when that policy matures, and assuming that the policy is issued after 1st April 23, then the money which you get back will be regarded as taxable and will not be taxable. And, you know, it might look as to what the hell is happening out here. But the fact of the matter, if you do a proper analysis, is that most insurance companies were selling 90% of their insurance policies as savings product rather than as real insurance product. And therefore, the government has come back to say, we will tax what is the true character. Whatever you have earned out here is income and it is not something which is tax-free. Number of sub changes which have happened. And several things which have been done to avoid litigation or sort of give it. Take for one last example I would give you is with regard to Section 28, where the issue was that a perquisite arising from a business would be taxable in the hands of the person who's carrying on business or profession. And the technical view was that since the section spoke of whether convertible into cash or not, cash itself is not covered by the section. Now again, a hyper-technical view, but if you are making money, whether it is cash, partly otherwise, and it's taxable as income, you've got to pay your taxes. You cannot be taking technical interpretation. So again, all of these things set to rest. And I would say that this is cleaning up and sort of putting a lid on smart LX trying to do sharp interpretations of law. Several provisions which are very welcome. For example, the introduction of a level of joint commissioner appeals. So we found that there was a sort of a stoppage of appeals at a commissioner levels. It took years to get order. Incidentally, I might mention, and I don't know how many of you would be aware, but the government has done a very good job in terms of appeals before tax tribunal. Earlier, it took you 4, 5, 6 years to get an appeal heard. Today, it gets heard within 4 to 6 months at most locations. In some locations, at best, it is a year. A very, very welcome change. But there was this whole bottleneck at the level of commissioner appeals, and what has now been provided is that the government will appoint about 100 joint commissioners to deal with small appeals and clear off. So all very, very welcome steps. More important, and I think it's very important, and we should not lose sight of the fact that this is the first time in the history of the country that our tax to GDP ratio has moved to double digit. It used to be single digit. Now it has gone about 10%. Very, very welcome. The next year's budgeted tax revenues at 23 lakh crores again look quite reasonable. We are seeing tax buoyancy, and that buoyancy should continue. And I'm hoping that with all the proposals that have been brought about, we will see stability in tax laws. One final comment from my side is that there was a particular request which we as FICCI had made to the government and has not found favor, and I do hope that the government will reconsider this, is that we have a 15% rate of tax for new industrial companies, which has now been extended to cooperative societies also. That comes to an end on 31st March 24. That is, the manufacturer has to commence before that. Our proposition to the government was that people are truly looking into India as an alternative to China. Setting up manufacturing projects takes time. It is not something which happens in 6 months, 1 year. It takes a couple of years. I'm personally working on a number of large projects, and I can say this at first-hand experience, that if we extend this time limit, we can see more and more money flowing into the manufacturing sector. The government has not considered this. I hope they consider it maybe next year, because we still have time till 31st March 24. But that's one disappointment. Otherwise, I would say a very, very positive budget. With that, I hand it over back to you. I'm sure my colleagues will take you through an in-depth detailed analysis of each one of the provisions. Thank you so much for having me with you.
Thank you, sir. Now we move on to perhaps one of the sections which is extremely critical and important for people to understand, and also in simple words. And we could not think of anyone better than Professor Dr. Obidip Sarkar to explain it in the words that we want to hear it from. So here it is. I would request Professor Dr. Obidip Sarkar to kindly share perspectives on the Union Budget of 23-24, the economic perspectives of the Union Budget. Thank you, sir.
Thank you very much for giving me this opportunity to speak here on the budget. I will give you an economic perspective, of course. I shall not confine myself to an industry perspective, but of course I will talk about industry perspective, but I will talk about other things as well. I'm told our Honorable Finance Minister was a student of economics once at JNU. And I can see that in her budget. It's almost, a part of this budget is almost from a macroeconomics textbook. There's nothing wrong with that, of course. Personally, I feel quite comfortable with that because I can see what she's trying to do. Now, whether she can achieve what she's trying to do is a different question, but her intentions are quite clear. Now, what is she trying to do? In a standard macroeconomic setup, we have the government, we have the private sector. And the driving force is expenditure, external expenditure. Now, in this budget, this external shock or driving force is coming from capex. That's clear. There has been a huge increase in capital expenditure, which is laudable, of course. And that is taken to be the driving force for the economy. So what does it do? An increase in government expenditure basically increases the infrastructure, basically improves the infrastructure and increases the productivity, improves the productivity of the economy. It has two effects. One, demand side effect, the other, supply side, longer run effect. On the demand side, as soon as the government starts spending, jobs are created. And when jobs are created, of course, people are getting money as income. And those people are again spending part of that income. And that is the start of the so-called multiplier process. Our Honorable Finance Minister has indeed talked about the multiplier process. It works like this. Once the government spends money, jobs are created, income is generated, private income, and part of this private income is spent back, comes back to the economy, and that creates more jobs, more demand, more jobs, more output, and so on. This is the demand side. On the supply side, one has to realize that this is not just any expenditure. Government expenditure could be, consumption expenditure, just, giving out salaries to people and so on. It's not that. It's capital expenditure. So it's going to increase the long-run productivity of the economy. And that must attract private investment. In economics, it's called crowding in. And she has indeed used this term in the budget. Government expenditure crowding in private investment. So in the long run, when this infrastructure is set up, private investors will find it worthwhile to invest more because it's more productive, because it's more profitable. And so there is a private-public nexus which will drive the growth in the economy. So that is quite clear. And that is, directly from a textbook, I would say, but there is nothing wrong with that. In addition, she has given emphasis on so-called modernization of techniques of production. She has talked about, digital economy. She has talked about artificial intelligence and so on and so forth. So the technology has to be increased as well. Moreover, apart from the rise in government expenditure, capital expenditure, there is yet another push to the economy. And that is coming through a reduction in personal income tax. So, a reduction in taxes at various levels will increase disposable income, and that will create further demand. So there are, two shocks, external shocks, so to say, in the economy. One is rise in government expenditure, and the other is fall in taxes. The two taken together is expected to create a very comfortable multiplier effect for the economy. So this is what she is trying to do, and in addition, as I said, she is, going in for technical progress, for different types of R&D, for artificial intelligence, and so on and so forth. So that is very clear. Her intentions are good, intentions are clear, and I'm sure they are going to work. Now, I will talk about some doubts that I have. The budget, as you can see, has 7 priorities. It's called Shaptoshi. She has called it Shaptoshi. 7 priorities. And the very first priority is inclusive growth. Now, I have some doubts about that. If you divide the population, usually we divide, when we are talking about income distribution, we divide it in 4 groups: the top 25%, the middle, and so on and so forth. Now, the bottom 50% of the population, they are not doing very well. Just to give you the perspective, the proper perspective, there is a recent research paper by Piketty and Chancel. Piketty is quite famous actually, doing his work on inequality. It's on the Indian economy. Now, what they have come up with is the following. They have looked into growth and inequality in the Indian economy from 1950 to 2015, quite a long period. They have found out that from 1950 to 1980, growth was limited. Growth rate was around 1.3, 1.4%, the so-called Hindu rate of growth. And during this period, inequality actually went down. That is, the growth of income of the bottom 50% was higher than the growth of income of the top 10% or the top 0.001%. Actually, during this period, income of the top 0.001% actually went down. There was a negative growth. Just remember the huge taxes in those periods, more than 90% taxes. So, during the first phase, growth was low, but inequality was falling. In the second phase, we had the so-called, gradually we had the so-called liberalization, globalization, and so on. So, from 1980 to 2015, growth rates increased substantially. Average growth rate was 3 to 4 times more. However, for the bottom 50% of the population, income-wise, it was, growth was very slow. I won't say it's stagnant. It was stagnant. It was not stagnant, but the growth rate was about 1% per year. Whereas, for the top 10%, growth was about 5.5%. And for the top 0.001%, annual growth was more than 10%. So, there was a huge rise in growth rate as well as a huge rise in inequality. So this is the reality. Now, whether you choose low inequality, low growth, or high inequality, high growth, that's a that's a different issue. But ideally, we need growth. Of course, we need growth, but we need to reduce inequality as well. The problem is that the bottom 50% of the population, people do talk about trickle-down growth. What is trickle-down growth? It's basically argued that if growth happens at the top, it will gradually trickle down to the bottom. But the Indian experience is that it does not happen. So basically, in India, it's as if the income earners are divided into two watertight compartments, two separate compartments. One compartment is very static, does not move for the bottom 50%. The other one is moving very fast. So people like you and me, we have nothing to worry really. You know, this budget is good for us. But for the bottom 50%, I'm not so sure. Of course, when the Honorable Finance Minister talks about inclusive growth, she has listed a number of steps or measures that she is going to take. Now, these are all sort of piecemeal measures, you see. These measures will come across similar measures in all past budgets. They have not substantially improved the condition of the poor. The main problem is that for most poor people, they just cannot participate in the market process because they are unemployable. They don't have the proper education. They don't have the proper training. So they are simply unemployable. So even if we have a demographic advantage, a large part of the population does not have the required skill. So ideally, a budget should address the problem of including these people into the market process. I'm sure the market is delivering a lot to the people who are at the top 50%. But for the bottom 50%, I'm not so sure. I'm worried when I see that the allocation to education is going down every year. It's even less than 2.5% of the total expenditure. So first you have to educate the people. This has happened in China. This has happened in Korea, South Korea, even before. And then you can involve them into several productive, ways of earning income. For example, in China, they had manufacturing units at the local level. And that involved, these manufacturing units were very, very efficient. They could compete with anywhere in the world. And they were producing small things, toys, scissors, knives, and so on. But wherever you go, you will find Chinese manufacturing goods. But these goods were produced at the local level, even at the village level. So that kind of, endeavor is absent here. First of all, we need manufacturing, because manufacturing involves more people who are not, manufacturing does not need that much education like in the, services sector that we have, especially IT. So we need manufacturing first of all, and this manufacturing must involve people who are still out of the growth process. And that needs some innovative thinking, which I do not find in the budget. But overall, I would say that this is a good budget, very good budget. And as I said, I will repeat that for industry, for middle class, for the affluent, it's a very good budget. For the economy, if you just confine yourself to growth, I think we will grow very fast. However, the hesitation is that people at the bottom are still left behind. Thank you very much.
Thank you very much indeed, sir. With this, we come to the opening session of today's proceedings. We now have a pleasant task to perform. We would request President Mr. Shubhi Chakraborty to kindly hand over a token of appreciation to Professor Dr. Obhirup Sarkar on behalf of the Chamber and Dhruva Advisors LLP. Thank you. We would now quickly move on to the next session. We would request the Secretariat to kindly do the needful in terms of changing over. Thank you, sir. So the next session is on direct taxes and indirect taxes proposals of the Finance Bill 2023. We would have our expert comments on this. I am pretty sure this is going to be an interesting session today because of the modalities and the announcements that has happened yesterday, and people are looking to understand the finer prints in minute details and try to infer from that. So we thought that this would be an interesting session. This session would be helmed and moderated by Mr. Aditya Hans, partner, Dhruva Advisors LLP. I would request Mr. Aditya Hans to please come up on the dais. He is with us physically. Mr. Aditya Hans is a partner in Dhruva Advisors LLP. Prior to this, he was a partner in KPMG. In his 16 years tax consulting career, he has been actively involved in advising clients across spectrum on reorganization of group structure, promoter family interests, mergers, demergers, family settlement arrangements, transaction advisory, tax due diligence, international cross-border tax structuring including transfer pricing, private equity attribution, inbound and outbound entry, exit and profit cash repatriation strategies. Sir, I am pretty sure Mr. Gautam Adani is looking for you right now. We also have Mr. Ruturaj Bhire, Principal, Dhruva Advisors LLP. He has joined us online. Can we have Mr. Bhire? Yes, you're physically. That's a pleasant surprise. Mr. Vasant Gadhian, he is also a Principal, Dhruva Advisors LLP. Mr. Gadhian has joined us on. Oh, he's also physically here. Wonderful. Great. So we can commence the session. Over to you, Mr. Hans.
Mr. Chakravarti, Mr. Kanavar, Mr. Avirup Sarkar, Rituraj, Basant, friends, it's an honor that we are able to hold this session jointly with BCCI, and such a wonderful audience, a house full. You know, probably this is one of the first sessions I'm doing physically after the pandemic. I remember we did the last 2 sessions with BCCI virtually, and it's so welcoming to see a full audience, and many more who have joined it virtually. Before we delve into the tax provisions in detail, it would be unfair that if I don't discuss certain pointers from the economic survey which set the tone for the amendments. And in this regard, I would like to discuss some of those key observations which I found from the economic survey, and some of the proposals, some of the which are there in the budget. So if you look at the budget this year, it's the last full-fledged budget of the Modi 2.0 government, where its focus has been on the rural sector, social sector, infrastructure creation, and also good attention has been given to the middle class, which was, to be honest, ignored to a large extent over the last 3 budget sessions. The focus for the budget is on capacity building, enhance through capital expenditure on smart cities, roads, highways, and railway lines. Look at the outlay for the railway. Look at the outlay for the infrastructure. The government has reaffirmed its commitment towards inclusive growth by giving relief to the middle class people, giving relief to MSMEs, encouraging women empowerment, and also giving some sort of assistance to the senior citizens. If you look at the world bodies and also government's announcements, they're all suggesting that the Indian economy would witness a real GDP growth of 6 to 6.8% in financial year 23-24, and a fiscal deficit pegged around 5.9, and which is expected to go down and taper down in future. Now, some statistics from the economic survey which also suggests this kind of a trend. So, if I look at this slide, please closely, and you know, I believe an economic survey, and our Honorable Professor Avirup Sarkar, he would also confirm that an economic survey is sort of a pulse of the government. So if you look at the last 11 months, I think I'll stick to this one. In the last 11 months, the world economy has faced almost as many disruptions as caused by the pandemic in 2 years. The Russian-Ukraine conflict in Feb 22 caused the prices of critical commodities such as crude oil, as you can observe from here, that particular red dotted line which you can see, it had gone up significantly. Crude oil, natural gas, fertilizers, wheat, everything had soared up. The rising commodities have also created inflationary pressure in the emerging market economies, developed economies as well, and had a cascading effect on multiple sectors. But it is clearly from the graph that we are coming back to the pre-conflict levels. You look at the end of the graph, there is a tapering, it's coming down. Government has been able to contain it to a large extent. World over also it is getting contained to a large extent. Now if I look at this, which is inflationary trends, there is a steep rise in the commodity prices trended by the inflationary pressure that the global economy recovered has triggered back after a lot of fiscal stimuli by the government. Inflation in advanced economy, which accounted for most of the physical expansion and monetary easing, breached historical highs. You would have never seen inflation at 8%, 5% in developed economies. Inflation was 0.5%, 1%, 2%. That's why the interest rates were also lower in these developed economies. But for the first time, things have changed. And due to this conflict, COVID was one reason, they were getting out of it. The Ukraine-Russia war, that conflict came on. The country's retail inflation has crept up above the RBI's tolerance range in January 22. It remained above the target range for 10 months before returning to below the upper end of the target range of 6% in November 22. With monetary tightening, the US dollar has appreciated against several currencies, including the Indian rupee. However, the rupee has been one of the better performing. So let me put it this way. Things have been bad, but we didn't perform that bad as the other economies. The increase in investment demand has emerged a powerful stimulus to the industrial growth. Look at the capex, look at the private investment. It has been triggered by capex by the central government in recent years, and there's been a lot of funding from the private sector also. High capex, a lot of private investments happening. Government has been able to contain inflation to a large extent. Things could have gone bad, but they've somewhere been contained. Well, if things are falling in place, something good has happened. There's been buoyant tax collections. Never away. Again, you would have heard my chairman, Mr. Kanava, saying that finally the tax collections have reached a double digit, something which has never been in the past. A lot of money in the pocket, lot to spend. Where do you spend? Revenue, capital. They decided capital. Capital has a more enduring effect. So tax. You're getting the money to spend. You're getting money to push it back into the economy. Well, we all know, everyone is talking about a big major recession in 23-24. But if you look at the projections from all across the world, whether it's the United Nations, OECD, Citibank, all the analysis, if I go back couple of, let me go to this slide. Fitch, Moody, S&P, all of them are talking about high growth for India. Whereas the world growth will be 1%, 2%, but they are talking about a high number not only for 23-24, 22-23, but also for 23-24 and years going forward. Well, something is going wrong. It's all because of the tax and the money government has got in the pocket. I got money in the pocket, I'll push it back in the form of capex expenditure, and as rightly said, it's got a multiplier effect. So tax is very important. Tax is very important. Now, if I look at the finance bill, and I'm sorry I took the liberty of moving into the economics part of it, I'm not an economist, but I could see that if I don't set the tone why tax is important, would not get everyone's attention. Although I think so the personal tax has got everyone's attention, but again, tax collections are also coming largely from corporate tax, personal tax, excise. Excise has been little down, but GST collections have been up. So tax is very critical for the government. More money, more spend, better GDP growth. So if I look at the amendments which have been there, I can put them into 5 buckets. The first one will be encouraging consumption or spurring demand. The second one would be encouraging investments by ease of doing business. So one is improve consumption, give more income, more disposable income. That is where on personal taxes this is happening. I'm giving approximately to people earning more than 15 lakhs and above, 50 to 55,000 in their hand. That means 5,000 more per month. That means they will be more buying of white goods. This will kick in the economy and the multiplier effect continues. More cars being bought because I have the ability to spend 5,000 rupees on an average per month, 4 to 5,000 rupees per month. That middle class which is earning between 10, 12 lakhs to 20 lakhs. So the second one being encouraging investments. Well, okay, I've given money in the hands of people to spend more, but I also need to ensure that there's more capex, PLIs have been there, and many more initiatives by the government that new businesses are being set up. Who want to set up new businesses, it's more easy, single window clearance and many more things. Well, if I simply start distributing money, I also need to ensure that I keep on collecting more also, because if I don't have money, again I'll not have money to spend. And if I don't have money to spend, tank goes the economy. So then I have to widen my tax base, and as rightly highlighted by my chairman, that there were a lot of adventurism done by many people on having very strict interpretations and saying that the word cash is not there, therefore anything which comes in the form of cash is not taxable, therefore it is not taxable, or some interpretation which you are doing, very aggressive interpretation saying the word this was missing. So government has been wise enough. There are still many loopholes, but caught hold of many of these small loopholes. The abuse of the provision which are happening in the garb of reading the law in a particular manner, interpreting the law in the manner, have to plugged in those, and therefore thereby widening the tax base. there were many things which were due to some rulings in the past, say a PILCOM ruling in the past of the Supreme Court, there were some ambiguities getting created. So I will appreciate that they have rationalized many of this, that they have rationalized the multiple 21, I think so there were 21 odd, my colleague Rituraj will speak, there were 21 odd custom rates and they have reduced it to 13. So this is something very encouraging, you know, they are rationalizing it, trying to make it simple, but income tax can never, and says, and indirect taxes can never be simple. But there is an effort, there is an initiative, so that's also an encouragement. And on certain positions, they wanted certainty to be there. So people used to say, give me clarity, you want to tax it, you tell me. You tell me what is it applicable for 2017, I'm clear. You tell me what has to be done. So they've given tax certainty on many of the aspects also. So that is also appreciative. I'll just touch upon each of the 5 buckets, what they've covered. So if I look at encouraging consumption or spurring demand, so by revamping the slab rates of individuals under the new regime, the finance ministers left higher disposable income up to 52,500 per annum on income of around 15.5 lakhs, which is likely to encourage consumption and spur consumer demand. Now if I look at encouraging investments by way of ease of doing business, so for enhancing ease of doing business, more than 39,000 compliances have been reduced and more than 3,400 legal provisions have been decriminalized. For furthering the trust-based governance, the finance ministers introduced the Jan Vishwas Bill to amend 42 central acts. The budget proposes a series of measures to unleash the potential of our economy. It has also, the finance minister also been pragmatic, increasing the threshold under presumptive taxation for eligible businesses to 3 crores and from existing 2 crores and 75 lakhs for professionals. But please be mindful, my colleague Basant will discuss in detail, that the quantum of digital payments you have will make you qualify for these beneficial provisions. So in the garb of this, they are also pushing digital economy. The startup community will also cheer the extended timelines granted for setting up startups by 1 more year. Well, it's been extending 1 year for the many years. I wish they gave a simple window of 5 years and then stop, but okay, that's the way the government works. And an extended period for claiming losses in case of change in shareholding. Quite a welcome move. I think so, if you look at the earlier speeches also, the finance minister, the Ministry of Commerce, Minister of Commerce and even a Prime Minister, they've all shown a lot of confidence in the startup community. It's encouraging entrepreneurship. Some of the word unicorn has got, it's like the new age thing, you know, everyone has got a fancy for the word unicorn, everyone. So there's a target that there should be X number of unicorns. So I think so this is in a path, or this is encouraging that to happen. So that's why I'm saying encouraging investments by ease of doing business. Now if you look at the GST front for encouraging investments by way of ease of doing business, the budget introduced some recommended changes such as decriminalization of GST laws and also allowed dealers under consumption scheme to supply goods through e-commerce operators within the state, which is widely appreciated. So again, in a way, pushing the digital economy. However, the imposition of penalty of e-commerce operator for non-compliance by suppliers supplying through it is a little bit concerning, but you cannot have it all. Now, if I look at the widening of tax base, for HNIs, the finance minister has removed the exemption on non-ULIP policies. So I think so the HNIs, it's a give and take. The highest tax slab, which was 42 point something, roughly around 43%, has been brought down to 39%, because the highest surcharge, which was 37%, has been removed. Now the highest surcharge is 25%. So in effect, they're given a benefit, but they've not given a benefit to people in the salary range of 1 to 2 crores. So rather 1 to, I think so, 5 crores also they have not benefited. People who are above 5 crores have benefited a lot more. So high net worth individuals, reason to rejoice. Someone having an income of other than dividend income, other sources of income and everything, to the tune of 5, 8, 10 crores is savings running into lakhs, 20 lakhs, 30 lakhs. I was doing some stimulation. Some promoters will be saving 20 lakhs, 40 lakhs, 30 lakhs of taxes. But yes, the government is smart enough, if I'm giving you something, I'm going to take away something. And this is a systematic approach which I've been seeing. If you remember in insurance policies, on the ULIP based, they plugged that opportunity where the high net worth individuals used to put in a lot of money in insurance policies which were ULIP based. Now they've also tried to plug in on the non-ULIP base. So that's an opportunity where, and I remember that if you have high premium policies, very high premium policies, where the premium would be 10, 20 lakhs per annum or even higher, the IRR could be as high, and this is tax-free IRR. And I've myself seen a brochure once. It was as high as 7.4%, 7.5% tax-free IRR. But now you cannot. So if, and Basant will discuss this in detail, and it's a very interesting provision because whenever you bring a provision, there's ambiguity around it also. So premiums beyond 5 lakhs, if you're there, you'll not be eligible for that. Up to 5 lakhs. So that's an opportunity where the high net worth individuals used to save a lot of taxes in future, on the future income after 15 years, 20 years. That has been plugged to a large extent. Then again, it was a very common phenomenon for tax planning, and it was a very legitimate and good way of tax planning. You have a big residential property, you sell it off, you buy another one, bigger one, residential property, or you have stocks and shares, you sell it off, you get a lot of money, you go and buy a residential property. So you reinvest in residential property, and I know people have bought residential properties of 60 crores, 80 crores, so all those luxurious apartments we used to hear in Bombay and the NCR region. Well, Calcutta doesn't have that share of luxurious apartments of 40 crores, 50 crores. But all of that which was being bought was under this planning idea by the high net worth individuals. That has been plugged in also. So something, so this way they will collect more taxes. So that's a widening of the tax base. Reduction in the tax rate for high net worth individuals, yes, but at the uppermost slab. But yes, I'm taking away that planning opportunity. There's rationalization. If I look at rationalization, they've addressed the practical difficulties in claiming tax rate for income offered in years in welcome step to rationalize. So there was a mismatch in the year when you used to take a credit of those taxes. Under a TDS provision, you can go to the assessing officer, submit your documents and take a credit if there's a mismatch in the year. Very good initiative. Something, which used to be an administrative hassle. Thanks. They finally thought through of solving the problem. To reduce pending litigations, it has proposed to introduce joint commissioner appeals to handle specific low profile cases, low value cases. Further reinstating the timeline to complete, because what was happening? Government started with 21 months to complete an assessment, brought it to 18, brought it to 12, then brought it to 9. But it needs to understand that its machinery is not that efficient. And what was happening in that hurried manner of 9 months of completing an assessment in 9 months from the end of its assessment year, they were absurd adjustments happening. And they realized that mistake and they brought it back to 12 months, which is the least they could do. So good, they have rationalized these provisions. And on tax certainty, I'll say it's a welcome step in clarifying that high C sales, supply of warehouse goods before clearance for home consumption is a non-GST supply with retrospective effect since the introduction of GST. Now, with this, I would like to invite my colleagues Basant and after that Rituraj, but before that I'll introduce Basant and Rituraj. Basant is a principal in the firm and is a part of the merger and acquisition practice in Calcutta. His focus is on M&A, restructuring, and believe me, there's ample opportunity which he's exploring. We never thought Eastern India could throw such opportunities, but his hands are full. He has, so I'll say it's a little late awakening, but there's a lot which is happening in Eastern India. And when I say Eastern India, I will cover the 8 odd states which are there in Eastern India, including Northeast, Odisha, Jharkhand. Believe me, a lot of activities are happening. Japanese companies, German companies, Indian promoters making acquisitions, lots happening. He has over 15 years of experience in advising Indian and multinational clients in direct and regulatory across various sectors and on complex transactions. My other colleague Rituraj, he has 14 years of experience in indirect tax consulting. He has advised clients on issues concerning matters of legal and strategic nature for indirect tax. And he's a regular speaker at various forums and workshops. Basant, over to you, please.
Just a couple of minutes by the time the slides are being put up. Thank you, gentlemen. And for a moment, I thought maybe I'll have to run this without the slides. Maybe we would be deprived of that, but thank you. And thank you, Aditya, Dinesh sir, for this opportunity, and thank you, BCCI, for having us yet again here in front of you for taking the budget session. Moving directly to the direct tax proposals, the most important one which is impacting everybody is the new tax slabs. So over the years, we have been seeing a lot of changes in terms of the regimes which were there. So there was a corporate tax regime where the FM introduced 2-3 years back a concessional rate of tax, making the tax rate to 22%. At the same time, they introduced a concessional slab for individuals also. But over the past 2 years, they didn't see that there were much of SSEs who were opting this concessional rate of 115 BAC, so to say, which is the old regime as of now today. To incentivize this and to sweeten this, what the FM has done, instead of a long list of 7-8 slabs, they have cut it down and made the base rate starting from 3 lakhs with an exemption up to 7 lakh rupees of income. Obviously, it comes with a rider that you will not be eligible for claiming any deductions which are there for section 80C, which is the most popular one, the section 80D, which is for the medical deduction towards insurance premium for medical. And the tax rates have been marginalized. With every 3 lakhs of income, the tax rate is increasing by 5%. If you can see the slide in front of you. There is a standard deduction of 50,000 which has been introduced in this new tax regime, which was not there earlier. At the same time, what the FM has done, as has been discussed earlier, is that the maximum marginal rate has been reduced because of the reduction in the highest rate of surcharge. So prior to this budget proposals, there was a surcharge of 37% whenever the income exceeded 5 crore rupees. Now that highest surcharge of 37% has been removed altogether, the highest rate of surcharge now is 25. So essentially what it means is the people who fall in the highest tax bracket, their taxation has been limited. And at the same time, if we see the oldest tax regime, the so to say the school of thought where we have our old tax regime, that continues with all those deductions which we have as of today, 80C, 80D, 80G, all those deductions are there. And this new 115 BAC have been made as a default tax regime now. So earlier what used to happen is that the old regime of 30% base rate was the default regime, and if one were to go for a lower concessional tax regime, you would have to be opt for that new regime of 115 BAC. Now with this budget proposals, what they have done is that they have made this 115 BAC regime as a default regime, and if you want to tax yourself in the old regime where you want to take more deductions and all, you have to come out of the new 115 BAC regime and go to the old regime. So obviously there are a lot of there are now 3 sets of regimes for one to think of. To put it very simply, if one were to compare the earlier 115 BAC regime which was there till financial year 22-23 and the new one which will now be effective hopefully once the budget proposal receive the presidential assent, we see that the substantial savings obviously would come to the higher income groups, obviously because of the surcharge reduction, where the maximum marginal rate which was earlier around 42.7%, that has been brought down to 39% finally. So in a sense, what the FM has done, that she has made 115 BAC more attractive, and she wants to ensure that like corporates are moving to the new regime which does not have any deductions and exemptions, she wants to incentivize individuals, body of individuals, AOPs also, to move to a regime where there are less of deductions and pure slabs, so to say. So if you see on an income of approx 6 crores, there is a tax saving of somewhat around 22.5 lakhs if one were to go by broad calculations. Obviously this would all depend on what income slab you also fall into and what kind of deductions you have been claiming. Like for an individual who may be claiming a house property interest deduction as well as an HRA deduction, and if suppose he is falling somewhere around a 15 to 17 lakh bracket, it may also end up that he would be better off remaining in the old regime and not opting for this new regime. So there is a lot of permutation combinations which now you'll have to sit and discuss with your consultant in terms of what regime to go for. Because if you don't choose which regime you need to go, you will be automatically shifted to the old regime. Sorry, the new BAC regime. So that one careful point one needs to be noted of this default option, the default provision which has been inserted. Moving further, for high net worth individuals, what changes have been introduced for section 54 and section 54F, which was essentially a tax provision where incentives were given for promoting housing whenever there was a long-term capital gains. So one section pertained to under section 54F, when you sell a residential house property and you buy a residential house property in place of that. And section 54F is a section where you sell a long-term capital asset which is not a residential house property, like suppose you sell a shares or something and you invest those proceeds in a residential house property. So earlier what used to happen is that the high net worth individuals and elite class used to invest handsome amount in luxury apartments, villas, farmhouses, where you know the cost of such new houses were running into crores and crores. Going by the intention to promote housing, mass housing so to say, is what the budget memorandum says. The FM suggests that since a lot of people have been claiming this high deductions of section 54 and 54F, they have brought in a cap of 10 crores in terms of the cost of the new asset which you are going to buy. So in a sense, what would happen is that the amount which is getting invested in the new house property, whether it happens to be 10 crores or whether it happens to be 50 crores, the capping would be there at 10 crores. Meaning thereby any additional amount which you are investing more than 10 crores would not yield any effective tax deduction for you under section 54 or section 54F. So this is one step where the high net worth individuals should obviously feel the pinch. The second one also is in terms of the insurance policies. So every year or every 2 years, so to say, what we see, there are a lot of changes in insurance policy, which now makes me think that, you know, the old saying from Benjamin Franklin that, you know, nothing is certain but death and taxes. So if you die, you don't pay taxes, but if you are living and you are earning something, obviously you are going to pay taxes. So to put it in a nutshell, what is happening here is that if you are having any income from a life insurance policy which is above a specified limit of premium being paid, you will end up paying taxes, whether it is a ULIP policy or a non-ULIP policy. Earlier, suppose if I step back and see around 10 years ago or so, there were no restrictions on any kind of policies. Slowly and steadily they brought in the capping in terms of the policy premium of 10-20%, then they brought it to 10%. Then there were a lot of changes in terms of the keyman insurance policies, where corporates used to take the keyman insurance policy and assign it to their promoters. Those planning avenues were plugged in. After that, they could see that after doing this, there were still a lot of policies which were getting untaxed, and they introduced provisions to at least ensure that there was a proper tracking of the receipts of insurance policies by introducing a 1% TDS also. Effectively, that also did not, I think, yield the results what the government wanted. So they slowly brought in the capping for ULIP policies 2 years back, where any payment of ULIP premium more than 2.5 lakhs, that was also supposed to be taxed. So in a sense, that those were the changes where the common man, the middle class was not touched, but the high net worth individuals, the elite class, the people who are earning handsome salaries and income, all those policies of ULIP were already plugged prior to this budget. Even exhausting all these kinds of conditions, still there was an observation that non-ULIP policy, which are kind of an endowment policy, there are a lot of policies which are having the characteristic of an instrument and they are getting untaxed effectively under section 1010D, so to say, of the Income Tax Act, which is where the entire exemption section works. So what the FM has done is that now any non-ULIP policy which is also there, which is issued from 1st April 2023 onwards, and the premium for such policy is 5 lakh rupees or more, those policies would not be exempted once there is a withdrawal or there is a maturity. And so the policies which are issued up to 31st March 23, so if we see the next 2 months, maybe we'll see a spurt of insurance policy being floated in the market for these high net worth individuals and the insurance companies. But after that, whatever policies are issued on or after 1st April 2023, there will be a taxation wherever the premium is more than 5 lakhs. They have also built in the provisions with respect to if you are buying multiple policies, how will you calculate those? It has been said in the memorandum that they would come up with the guidelines, so to say, as to how to compute that taxability and exemption in case you are having multiple policies which may not be aggregating to 5 lakhs, or in cases it may be aggregating to 5 lakhs. So as of now it will be too early to comment on how that will be computed, because there may be cases where individuals will be having suppose 3 policies of 2 lakhs each. So how do we tax those? But if you see the ULIP policy regime which came 2 years back, there the government had come up with a circular with all detailed examples as to how ULIP policies would be taxable when the premium exceeded 2.5 lakh rupees. So we are hoping in those lines only the non-ULIP policy taxation would also be introduced, but we'll have to wait for the government directions in terms of how those exemptions would be computed for normal non-ULIP policies. This is one loophole which has been plugged now. Sorry, excuse me. What used to happen is that as our chairman mentioned that whenever there was some smart planning or a good interpretation being done by the taxpayers, now the FM is trying to plug all those loopholes. So what used to happen is that any individual claiming section 24 exemption for interest on house property, apart from claiming the exemption under 24 and offering a net negative number to tax, once that property was sold eventually, say after 5 years, 7 years, what the taxpayer used to do is that he would also include that interest component as a cost of the property, index that cost, and finally his cost base while offering capital gains was enhanced. So this was coming out because there was no per se restriction under the capital gains section which said that if you have taken a benefit of section 24 for a house property, you will not be allowed to take any such benefit under capital gains section. Now this loophole has been plugged, and the proposal suggests that if you have taken any benefit under section 24, or for that matter any other provisions of the act, maybe in the ATC also for the principal component, you will not be allowed to use that component of the benefit when you are offering tax when you sell the property eventually. So what it also means, if one were to go for a deep reading, is that we have a capping of 2 lakh rupees for the interest component under section 24 for self-occupied house property. And generally the interest for earlier years when you buy a property of a decent amount, the major component in the EMI obviously happens to be the interest, and in most of the cases it so happens that the interest component in the EMI being higher, your annual payout for the interest component itself more than 2 lakh rupees. But you claim a reduction only up to 2 lakh rupees because that is the threshold under section 24. So by this introduction of this provision, one may also consider that the balance amount which has not been claimed as a section 24 reduction, you have been given an escape route, so to say, to claim it eventually when you sell the property. So put it very simply, suppose if you are paying EMI where on an annual basis we have paid 3.5 lakh rupees of interest. 2 lakh rupees of interest is what you get as a deduction under section 24 when under house property. The balance 1.5 lakh is a sunk cost for you because you don't get any benefit under the house property regime. But that 1.5 lakh which is excess, which you are not getting any benefit here, that 1.5 lakh can be eventually used when, if at all you happen to sell the property in future. You can index that cost and take the benefit. Towards accommodation, this is also something where in corporate houses, people drawing handsome salaries, promoter families and their second, third generation, what used to happen is that they were given lavish houses for staying, and the cost of houses in metros and the cost of upkeeping those houses and maintaining those houses was quite high if one were to see the proportion of salary which was being offered to tax for those rent-free accommodation. So there was a rate of 15% which was supposed to be taxed as a rent-free accommodation in the hands of the salaried employee whenever the accommodation was given by his employer. The logic what has been given in the memorandum is that there is one part in the Income Tax Act which deals with which deals with a 15% kind of the concessional rent given to an individual being employed with a company, and and for a accommodation which has been given not at a concession rate but given for accommodation, all those regulations are kept in the rules. So what they have done is that they are saying that we want to, as an intention, we want to consolidate everything. We'll come up with a mechanism where we will tell you how this needs to be taxed, and eventually we'll see some regulations or circulars around this as to how the taxability would work in terms of perquisite on accommodation being provided to the employee by an employer. Again, a small loophole which was there in the third bullet, if you see on the screen earlier, whenever there was gifts given by resident to non-resident, all those non-residents, whenever there was gifts given by resident to non-residents, they were taxable in 56(2)(10) whenever they were received by the non-resident. But if the person happened to be a not ordinary resident, it was not taxable in its hand. So what people used to take an advantage is that prior, when they were in a not ordinary resident status, they did not used to offer it to tax, because the law distinguished between non-resident and not ordinary resident. So now this provision has been amended to say that this would also include not ordinary resident as well as non-resident, which is always there. Moving from personal taxes to startups, every year we see some changes in the startup. There is one good positive changes for startups, and I would say a negative amendment also for them. The positive one being that the year for incorporation has been extended by 1 year. So every year we see that this is getting extended by a year rather than having a block kind of because that would provide a certainty to the startups to have the visibility as to by when they should be incorporated and what kind of business they would be doing. And the provision which is there in terms of change in shareholding, where the technical section 79 of the Income Tax Act, which says that if there is any closely held company like the startup companies, where there is any change in shareholding beyond 50%, then the losses which are there, which are lying in the company, the tax losses which are lying in the company, would not be allowed to be carried forward because the shareholding has changed by more than 50%. So when you incur the losses and when you set off the losses, the law requires that the shareholders should be at least 51% the same set of shareholders, just to ensure that there is no buying and selling of losses amongst companies. Now, in the startup ecosystem, if you see, this is a problem, genuine problem for startups, because no startups become profitable at an early stage. So earlier they had given an exemption for 7 years, that if suppose you don't earn any profits and have been accumulating losses for 7 years, we'll give you a breather of 7 years. But post 7 years, if there is a change in control by 50%, you would lose your accumulated tax losses. I think maybe because of the pandemic and in order to attract more startups setting shops here in India, so the government is trying to incentivize by increasing this time limit of 7 years to 10 years. So now a startup who is even having losses for continuously 10 years, until 10 years, if there is a change in shareholding, the losses would still remain in the company, even though the control, the shareholders of the company change more than 50%. That is clearly a welcome step for the startup community. However, one key negative for them is that they have kind of the anti-abuse provisions, which is there for section 56 to 7B of the Income Tax Act, which says that if a private company is issuing shares and the consideration which they get for issuing shares is more than the fair market value, so the excess component gets taxed in the hands of the company. So if there is a startup who suppose fair value per share is, as of today, as per the income tax computation mechanism under 11UA, so to say, is suppose 100 rupees, and which has been derived maybe by DCF method and all, which is justified. However, the company raises funds at 120 rupees. So what the law says is that 20 excess which the company is receiving on issuing share, that is taxed in the hands of company as income from other sources under 56 to 7B. This section till now was only applicable when you sought funds from a resident person, and if there was a non-resident who was investing into a company, these provisions was not applicable. So non-resident could invest money, in our example, let's say 120 rupees, but the residents if they would have invested at 120 rupees, the company would have been paying taxes on that 20 rupees per share. The budget proposals now say that we will treat non-residents at par with residents. So this restriction of getting shares consideration in excess of fair value will equally apply on non-residents as well. So now what will happen is that obviously there will be, maybe we'll see more realistic valuations from closely held companies, startups and all, where unless the valuation is properly justified, there would be obviously challenges for the companies for avoiding section 56(7)(b), and maybe we'll see some lot of issues when those share issuance are tested before assessments, because defending a valuation before an assessing officer, and that too in a faceless regime, is getting difficult day by day, and startups generally also do not have that arms and ammunition to justify all those valuations when they are before assessments. At the same time, maybe non-residents would also be somewhat skeptical in terms of valuations because earlier they could send any money at whatever valuation. Now all those valuation related jargons will come into play, maybe which may delay the process of raising funds by the startups. REIT and InvIT, I will not take much time because we don't see much of REITs and InvIT. The crux of the change is that essentially in the REIT and InvIT structure, you have a three-tier structure where there is a unit holder, and below the unit holder you have the REIT or the InvIT. REIT, the real estate investment trust, so to say, which invests in commercial properties and earns rental, dividend and interest income. So how the law has been positioned as of now is that whatever income is being earned by the trust, that is considered as a pass-through income, and the ultimate taxation happens at the level of the unit holders in the same nature as if it was earned by the unit holders. So till now, interest, dividend and rental incomes were always taxable in the hands of unit holders when it passed from the underlying asset holding SPV to the trust and then ultimately to the unit holders. But somehow whenever there was a payout in terms of the debt which was getting distributed, because there was some funding which was taken by the trust to invest in SPVs, but those funding never got taxed either in the hands of the trust or in the hands of unit holders. So now they have brought in a provision to say that even those repayments will be taxable. Obviously there would be an industry representation on this, because not every debt payment would be kind of a taxable event in the hands of the unit holders. So maybe we'll see some kind of representation or some changes in this provision. Moving further, NBFCs, there are not much changes, just that NBFCs NBFCs have been excluded now from thin capitalization norm requirements under section 94B, where wherever there was an interest payout by Indian companies in excess of prescribed threshold of EBITDA, the excess payout was supposed to be disallowed in the hands of the Indian company. And there was a carve out for non-applicability of these provisions to banks and insurance companies, but NBFCs was not covered in that space, although they were also part of the financial inclusion domain. So now the FMS extended this benefit to NBFCs as well. So NBFC is receiving funding which is very leveraged, and they are paying interest above the prescribed threshold. They would still not be covered under section 94B, so to say. This is the change which our chairman talked about, where there was a lot of interpretations in terms of what could be the cost of a capital asset, where it was a self-generated one or which you acquired without giving any money. So we have been seeing the Supreme Court judgment since maybe around 30-40 years back, since the B.C. Srivarsha Shetty celebrated judgment of the Supreme Court, where it says that the capital gains taxation, where it works, is not only based on the provisions, but it also has to necessarily respect the computation mechanism. So in the computation mechanism, if there are three components in terms of what is the sale consideration, we reduce the cost of acquisition and the expenses of transfer. So if there is no expenses of transfer, or the expenses of transfer is not determinable, what the Supreme Court has taken a position always is that since the cost was not determinable, the computation mechanism itself fails in the capital gains computation, so there would not arise any capital gains. So what used to happen is that in the garb of these decisions, there were a lot of deals and capital assets which were getting untaxed, because while there was sales consideration for them, the cost was not determinable. So now what the FM has done is they have put in a deemed provision to say that all these kinds of assets will be considered that the value is zero. So essentially what it will mean is that whatever sales consideration is being received on selling those intangible assets, the entire amount would be taxable in the hands of the taxpayer, obviously after reducing the cost of expenses on transfer, so to say. But cost deduction would not be available. There is a small change in electronic gold received, where the conversion from electronic to non-electronic and vice versa has been exempted from capital gains tax. One interesting change for market-linked debentures which has been brought in is that these debentures, so to say, what used to happen is that these instruments were mostly because debenture by its very nature would yield an interest to the investor. An interest income normally is taxable in the hands of the investor as in other sources or maybe business income. What used to happen is that there were instruments floating in the market which were a hybrid kind of an instrument, where they were nomenclated as a market-linked debentures, where the return on that investment was market-linked, but essentially the returns were of that of an interest only. So in the garb of interest, they were getting a market-related return, and because those instruments were listed, they were enjoying a reduced rate of taxation. Because if you see the Income Tax Act, whenever there is a listed instrument, there is a reduced rate of taxation for long-term capital. Earlier, if you see, there was nil taxation in around 3-4 years back, and then they moved to a 10% regime. But obviously it is still lower, and obviously it has to be lower than the short-term one. Now what the FM is suggesting is that these instruments are nothing more than in the nature of interest, and they have brought in a deeming provision, interestingly, to say that we will consider this as a short-term capital gain, short-term capital asset, irrespective of whatever time you are holding those instruments. So even if I am holding these MLDs for 2 years, so to say, 3 years, so to say, they would always still be considered as a short-term capital asset, and they will be taxable as a short-term capital asset, as against the 10% rate where they were being offered to tax earlier. Moving ahead, this is a very big change which has come in terms of Section 28 bracket 4 of the Income Tax Act and the 194R circular. If we remember, there was a change last year in terms of taxing the benefits or perquisites which many people were receiving, and there was an interpretation based on certain judgments that if those benefits or perquisites were received which was in the form of cash, those benefits or perquisites were not taxable in the hands of the recipient, because it would not fall in the technical jargon of Section 28(4), so to say. This smart interpretation have been struck down now by the proposed changes, saying that the intention of the law was very clear since the time it was introduced, I think from 1964, that whether it is cash or non-cash, it does not matter. If there is any kind of benefit which is being received, that is something which has to be taxed as a business income under Section 28(4). So this would surely impact most of the IBC related acquisitions which we see before the NCLT, where the major portion of the claims of the banks, there are a lot of haircuts being taken by the banks, and most of the loans are waived off. So the fate of those waiver of the loans of banks, there would be now an exposure in terms of examining how this Section 28(4) will apply, because a situation may arise that the person who's buying the asset from IBC may have to end up paying huge amount of taxes only because there is a write back of the loans for the financial institutions. Inventory, there is a small change in terms of allowing the officer to do a valuation of the inventory through a cost accountant in the assessment proceedings. Like we have the concessional tax regime for corporates where a rate of 17.16% is prescribed. If you say the Make in India rate, this has now been extended to cooperative societies also, and the conditions are more or less similar to that of the corporate also. Sorry. Only one point which needs to be taken care of is that just by reading this provision, one may say that let's go and incorporate an entity, but you need to be cautious that entity needs to be incorporated after 31st March of 23. So if you incorporate an entity now, you will not be eligible. You have to wait for another 2 months and then incorporate the entity to avail this benefit. Obviously, the time limit for starting the production is kept same as 24, which gives them a very small period of 1 year to commence production. It would have been better if a larger window would have been given, along with extending the window for the manufacturing companies' benefit of special rate. SEZs, they have been now told that you need to bring in the forex within 6 months when you bill out to your parties outside India. At the same time, they have been told to now file the return before the statutory deadline to be eligible to claim Section 10AA benefit. For civil construction companies, exploration companies, there have been changes from presumptive taxation where they used to take the double benefit of switching in and switching off the regime 1 year into presumptive and 1 year into normal. So there was some tax planning going around which has been plugged by this changes. For MSMEs, there has been quite a few welcome amendments. The foremost being that any payment which is being made to the MSMEs would be allowed as a deduction only if it is paid as per the timelines of the MSME Act. So obviously there are a lot of disclosures being given in the financial statements in terms of what is outstanding and payable to the MSMEs and how much transactions are being done with the MSME. To further enhance the MSME ecosystem, what the FM is proposing that if there is any payout, if any MSME happens to be your vendor and you are supposed to pay that MSME for his services or whatever materials, and if you don't end up paying him within the timelines of the MSME Act, you will not be allowed a deduction for that payment. And that deduction is not that you will be allowed later on when you pay, it's a sunk cost, full and final. So the MSME timelines as of now is a timeline of 15 and 45 days. What it says is that there is a timeline of 15 days you need to pay to the MSMEs. If you want an enhanced period, you need to have an agreement with the MSME, written agreement if I'm not mistaken, for making the payment to them, that too with an outer cap of 45 days. So essentially it means that number one, maybe corporates would have to ensure that they have proper documentation with all MSME related vendors to at least, or maybe they'll have to also revamp their working capital cycle payments for MSMEs especially to ensure that no payments get delayed beyond the statutory time limit. Otherwise, there is a permanent disallowance for payments under Section 43B of the Act, which is on payment basis. At the same time, for small businesses and for professionals, the presumptive taxation regime limits have been enhanced. For small businesses, earlier it was 2 crores, which has now been increased to 3 crores. For professionals like us, it was earlier 50 lakhs, which has now been increased to 75 lakhs. Business reorganization, last year there were changes, but the government felt that it was only half-hearted, and so they have now kind of made another attempt to make it a complete 170A section, where earlier there were only provisions whenever there was a corporate reorganization happening in terms of merger, demergers or IBC related orders. Obviously there was a time gap by the time the orders were received from the respective adjudicating authority, whether it was NCLT or some other adjudicating authority, and by that time the assessments of that entity which was getting merged or demerged was already over. So last year they brought in a change to give an ease of doing business, that once that order comes you can change your return, but this facility was only given to the successor entity. Like suppose if there is a demerger happening, there are two companies. The company from where the undertaking gets transferred, which is the demerged company, and the company in which the undertaking ultimately moves, which is the resulting company. So earlier law, what it said that you may change and modify the return of the resulting company, which is the surviving entity after, not so surviving entity, the entity which is the successor entity which is receiving the undertaking. And even, and now what they are saying that apart from the successor entity, the predecessor entity, which is the demerged company also in our example, that will also have a right to have its return of income modified. They have also increased the timelines of getting the assessments done for these kinds of cases. And the AO have also been given powers to rectify the orders in case orders have already been passed, or they have also been told to consider the order of the NCLT for passing assessment orders when the assessment is already underway and not completed. TDS, TCS related provisions, these provisions are something which comes every year with lot of procedural changes, like, if I may say so, charitable organizations. So there was no provision for TDS on interest on listed debentures. There was an exemption, a special carve out in section 193, which has now been removed. So all listed debenture interest would now be taxable. What the government felt is that nobody is offering this to tax, so why not put a tracking mechanism that it goes into the TDS system. So that's the reason why they have brought in. For mutual fund units also, this is more to do with non-residents. So they were not getting the rate as per the treaty if the rates are lower. So in terms of giving them a favor, it has been now allowed that if the treaty rate is beneficial, you can use that rate while making payments for mutual fund units. One very welcome change is that in terms of what happens whenever the return is being offered, income is being offered in the tax return, it may so happen that due to accrual system of accounting, a lot of incomes get offered to tax, but the corresponding TDS by the customer is done only in the next year. So there was always a practical difficulty in claiming the credit of the TDS. So in year one, what would have happened? You would have offered the income to tax, but since there was no TDS, in most of the cases, maybe you would have paid advance tax and or self-assessment tax to close the tax demand in the return stage. And in the next year, when that income was not offered to tax because you had already offered that in the previous year, there was a TDS from your customer in the subsequent year. So it was a cash flow issue where in year one you were negative by that amount, and in year two you used to get that TDS credit, and that too it was being litigated by the AO saying that you are offering TDS, but where is the income? So there was always a dispute that you are just claiming TDS without offering corresponding income to tax in the subsequent year. So this was a problem, perennial problem, which the FM has now realized, and she has acknowledged that these kinds of issues should be ironed out. So they have made a provision that you can get this order rectified whenever you get a TDS credit in the subsequent year. So one very talked about change is with respect to the online gaming TDS. So last year it was more of crypto, virtual digital assets. This year what they have done is all those gambling related income are all anyways taxed, betting, horse race. Now they have brought in the online gaming because nowadays we see the new modes of earning income through online games. So whenever now there is an online gaming and there is an income being earned, there is a flat rate of 30% now which will be taxable in the hands of the person who is earning income from an online gaming. And this is not a tax which needs to be paid by you. They have built in a provision where there will be a 30% tax deduction at the time when you withdraw the amount from the online gaming agency, or if you don't withdraw the amount, so to say, there will be a taxation at the year end. So suppose today this provision is introduced from 1st July 23 and not from 1st April. So suppose from 1st July 23 you are into this domain of online gaming and you end up earning a handsome amount and you choose to withdraw that amount, say suppose in the month of October, November 23. At the time of withdrawal, you would be taxable at the rate of 30%, which will be deducted by the agency which is providing the online gaming facility to you. Or suppose if you don't withdraw that amount and that amount is lying in the wallet of the service provider, so at the end of the year, which would be 31st March 24 in our example, it would still suffer a 30% tax withholding. And they have brought in a section 115 BBJ where they have said that now this income would be taxable in the hands of the person at the flat rate of 30% tax. they have been using the word net earnings. So, so which essentially means that it's not a flat rate of taxes on your positive earnings, if I may say so, but maybe there will be some clarifications on that as well. But as of now, what it looks like is that whatever net earnings you're earning, that should be subject to tax at a flat rate of 30%. One much talked about change in the for the community of wealthy high net worth individuals is the TCS on remittances overseas. So TCS wherever, so there is one mechanism of TDS where you get a payment after deduction, and there is another TCS where when you pay an amount for certain for certain purposes, you need to pay extra amount, and that extra amount goes into your tax credit in terms of a tax collected at source. So earlier what used to happen is that under the RBI liberalized remittance regime, which we call in short form as LRS, if there was a 7 lakhs payment, up to 7 lakhs of payment by anyone for LRS, that was not subjected to any TCS, and any payment above 7 lakh rupees was subjected to a rate of 5% TCS. So when you go to the bank and you are remitting 10 lakh rupees overseas, the bank would say that 10 lakh rupees is the amount which you are going to remit, plus there is a 5% which you need to pay as a TCS amount to the bank, and the bank would report that in the return, which you will get a credit when you see your 26 AIS, TIS, and you claim it in the return of income. Now what has happened is that the government has proposing to increase this limit of 5% to 20%. So there is a 4 times jump, a steep jump in terms of the rate of TCS which is supposed to be now applied, and this also comes with no threshold. So the earlier threshold of 7 lakhs has been done away with. So even if there is a small remittance of 50,000 rupees, it will still trigger a TCS of 20%. They have given a leeway in terms of LRS which is being made for medical or education purposes, for higher studies and for medical related examinations, medical related issues, where this will not be applicable. At the same time, for tour operators, I think this is something to do with the Dekho Apna Desh kind of scenario which Modi government is very much keen to promote tourism in India. So they want to impose 20% of TCS whenever there is a foreign package being booked through a tour operator. Dispute resolution they have formulated.
Basant, I would say that we've covered most of the important direct tax proposals. We will now move into the indirect tax, as there's been a little bit of a time overrun. So let Rituraj take over, please. No, I would suggest, please. Rituraj.
I think, yeah, that's almost it.
Unless we've covered most of it.
One change is that they have formed a joint commissioner to look into small cases where, because the backlog of appeals before the commissioner appeals is too high. Thank you.
Thank you, Basant. Please. Thank you very much.
Good afternoon, everyone. First of all, thank you, BCCI, for this wonderful opportunity. This budget has brought along quite a few changes in the indirect tax regime. We'll quickly run through the most important changes. The common theme for the changes that we are seeing is: 1, increase in export promotion; 2, domestic manufacture promotion and increasing the value addition in the domestic manufacture; and finally to increase overall ease of business. That's largely the theme for all the changes that have been brought along. Let's begin with changes in the customs law. The first change relates to the time limit for customs exemptions which are conditional in nature. In the last year budget, there was a provision which was brought along which sort of put a timeline for all conditional exemptions. So the change was brought last year that every conditional exemption will be valid only for the period of 2 years. This was creating a problem for a lot of importers, because number of exemptions are not necessarily limited to 2 years. So to resolve this problem, now there's a change which has been brought in, which suggests that the limitation of 2 years will not be applicable for customs duty exemptions in case of free trade agreements, preferential trade agreements, foreign trade policies, etc. The next change is in relation to settlement commission. Settlement commission under customs is known to be a not very active body. In fact, until recently it was unmanned, and only in December 2022 they've sort of gotten members, they have increased the benches of settlement commission with a thrust to use of that settlement commission. One change which they have proposed in the current budget is that settlement commission has been given a timeline that any proceeding of a settlement commission needs to complete within period of 9 months. And if order is not passed within 9 months, the settlement commission will not be proceeding ahead and the matter will go back to the adjudicating authority. So it is expected that there will be a faster churn of disposal of cases by the settlement commission because of this amendment. One change in the project imports, the solar power plants or solar power projects which were earlier enjoying benefits as project imports will no more continue to have that benefit. A similar change was brought in the last budget also, but now there is more clarity which has been brought in, which specifies that solar power plants and solar power projects will not be able to import goods under the import project imports, and they will not be getting those benefits. In continuation of streamlining of rates of taxes, as Aditya had mentioned earlier, that with objective of giving impetus to domestic manufacture as well as with an objective of streamline the rate structure, there have been several changes in the rates of tax, of basic custom duty, of social welfare surcharge as well as AIDC cess. Some of the key changes have been mentioned in the slide. There are actually quite a few changes which have come along, but if you see the essential theme of these changes, what they have done is all the finished goods which are imported, there typically the rates have gone up, whereas for raw materials as well as for capital goods used for manufacturing within India, the rates have been brought down. So if you see products like bicycles, toys, etc., the rates have gone up, whereas if we see raw material as well as capital goods for manufacture of, let's say, lithium batteries, etc., they have reduced those rates of taxes. So that's largely the theme of change in the rates of taxes. Moving on quickly to the GST law, we are seeing quite a few changes. Generally, most of the changes for GST get decided in the GST Council meeting. So budget is not really the only forum for GST law changes. So most of the changes, in fact, that we are seeing in the current budget are at the back of GST Council's recent meeting recommendations. One of the first change that we see is that now we have a timeline. There's a cap up to which the monthly returns or the annual returns under GST can be filed. So if a company has not filed GST returns for a period of 3 years from the due date, then they'll not be able to file such returns thereafter. So there is now a time cap for filing GST returns. One very important or welcome clarification which has come out is that high C sales or inbound sales, they were included as non-taxable supplies from 1st February 2019, and there was a doubt as to what happens for the first 2 years, what happens for the previous year. Now they have made it amply clear that for entire, right from inception of GST, right from 1st July, these merchanting trades and inbound sales will be treated as non-GST supplies. Here's one interesting amendment that has been brought in, which sort of can be matter of concern for many entities, that any inbound sales, which is basically sale of imported goods before consumption, before clearance for home consumption, if there is any sale, that sale will be treated as an exempt supply for purposes of computing reversals. So what that means is that if, let's say, I am doing inbound sales, if I am doing high C sales, they are treated as non-GST supplies, but the inbound sales which are there, those will be treated as exempt supplies for purposes of input tax credit reversals. Now this is a strange way of making a change which they have brought along. Actually, the genesis of this change was to take care of the sale of products by the duty-free shops. But the way in which the amendment has been brought along in the finance bill, it sort of casts a doubt on whether this will also be applicable for inbound sales. So we are hopeful that when the notifications come out, they sort of clarify that this is limited to duty-free sales, sales by the duty-free shops, etc., and not for typically bond-to-bond sales or warehouse goods sale as such. One key disappointing clarification which has come in is that input tax credit will not be available on CSR activities. This has been a bone of contention. There were multiple views which were being taken even in the pre-GST regime as well as in GST regime. There were favorable as well as unfavorable advance ruling. The recent one being favorable in case of Telangana AR. But now this controversy has been set to rest, and it has been specifically provided that any company which is incurring expenditure for CSR, that will not be treated as input tax credit. Many companies were taking a view that this is an eligible credit, so whoever has taken credit in past, that credit also sort of gets under the cloud and under the scanner of tax authorities. There's one interesting change which has been brought along, which is called as the consent-based sharing. So, and it's a part of the IT governance effectively, wherein what the GST network will do is that they will seek consent from the taxpayers and the data which is provided by taxpayers on the GST portal. So the data for GST registration, the data of returns as well as data of e-invoicing can get shared with other government agencies. So this is one sort of change which they have suggested. There's a lot of rationalization of penal provisions that we are seeing. So they have decriminalized some of the offenses. So offenses such as tampering with evidence or failing to provide information to the government authorities or obstructing of operations of an officer, etc. All these were earlier criminal offenses. Now they have been decriminalized. The monetary threshold for prosecution has also been increased to 2 crores. Earlier it was 1 crore. So now only fake invoicing is the only sort of offense which has a threshold of 1 crore. Any other offense will have a threshold of 2 crores for prosecution. As an industry, expectation was this threshold can be much higher because the number has to be significant at an entity level. But what we have now is that there's a slight increase. It has gone from 1 crore to 2 crore. Also, as far as compounding provisions are concerned, there is a relaxation that we are seeing wherein the minimum and maximum limit for compounding has been eased out for taxpayers. There are a few sets of changes that we are seeing under the e-commerce world. The first, Aditya already spoke about, that there's a composition scheme allowed for taxpayers supplying goods through an e-commerce. This wasn't the case earlier. Earlier, a dealer who's registered as a composition dealer was not allowed to supply goods through an e-commerce industry or an e-commerce portal. Now, a goods supplier will be allowed to do so. So services will still remain out of it. Service providers will not get this benefit, but goods providers will get this benefit that they can stay in the composition levy and still supply through e-commerce platforms. There are some penal provisions which have been introduced for the e-commerce. So if e-commerce entities do not, if they allow any unregistered persons to make supplies through its portal, if it allows composition suppliers to make interstate sales through its portal, or if it does not supply all these sufficient information in its monthly returns, then there will be a penalty of 20,000 or a tax involved, whichever is higher, which will be charged to these e-commerce companies. Finally, online information and data retrieval services. This is one typical service which always has a different taxability and is viewed very differently by GST authorities. So there has been a change in the taxability of OIDAR. The definition of services, the OIDAR services, as well as definition of recipient has undergone a change, as a result of which the overall scope of this taxability of service has underwent an increase. So the net impact of these amendments is that any company which is based outside India, and if it is providing online information data access retrieval services, for example, let's say there is a entity outside India which provides a database and Indian companies are using that database, or there are several education courses which are housed on the international entity and they are being used by Indian customers. So all these services will come under the tax net. The foreign entity will have to obtain GST registration in India and have to pay tax on it for all the supplies that it does for unregistered customers, right? So that's the change. And finally, the last change that we are seeing is with respect to central sales tax from the pre-GST regime. So now the CESTAT, which is the tribunal, is designated as appellate authority for all the CST matters. And all the CST pending matters at an appellate level will get moved from income tax appellate authority to CESTAT. So that's one change which we are seeing. With that, we come to an end of our tax related analysis. Thank you.
Thank you, Ruturaj. We will do a quick changeover into our next session. We're running behind schedule by around 20 minutes. The next session is our industry perspective on direct taxes and indirect taxes.
Okay, we will do a quick changeover, but before that we need to do something. We would like to present mementos to the speakers here on the dais. So I would request Ms. Angana Guha Choudhury, Assistant Director General, Bengal Chamber of Commerce and Industry, to please come up on the dais and hand over the memento to our esteemed panelists. To Mr. Rituraj Bhire first. To Mr. Basant Gadian. And of course, Mr. Aditya Hans.
I have more sessions.
I know. Thank you. Thank you.
They're running on.
Okay, so as we quickly do the changeover, we would quickly move to the next session. Mr. Hans stays at the dais because he's again moderating the next session as well. So the next session is on industry's perspective on direct and indirect taxes. I'm sure the industry will have something to say after yesterday's announcements. So we have Mr. Surej Balani, Head Taxation Tata International Limited with us. They are all joining virtually for this panel. So Mr. Balani, are you there? Can you hear us? Request the AV team to kindly,
Yeah, Mr. Balani.
Okay, yeah. Good afternoon, Mr. Balani. Can you hear us? Can you see us? We can't hear you yet. I think you're on mute. Not yet.
I'm also can hear you. Yeah. I can also, I think there is a problem in the BCCI part.
No, we can hear you now.
Okay, great. Hi. Good afternoon to everyone.
Hi, good afternoon. Thank you. We have Mr. Arun Ramachandran, Head Taxation, Tata Consumer Products Limited. Mr. Ramachandran, can you hear us?
Yes. Good afternoon, everyone.
Yeah. Can we see him? Great. And we have Mr. Gautam Sengupta, General Manager, Head Taxation, Eveready Industries India Limited with us. Mr. Sengupta, good afternoon.
Yeah, I can hear you. Good afternoon. Am I audible to everyone?
Yes, you are very much. So I now leave it to Mr. Hans to take the session forward. Thank you, Mr. Hans.
Nilesh. Rahul? Yeah. So I have structured my questions, I looked at we should have roughly around, I think so I've kept around 9 odd questions. And these 9 questions I've broken them into 3 to 4 slots. The first one being the most area of interest being personal taxation. And I would address this question to Gautam initially. Rahul was also supposed to be there, but somehow he's occupied with something. It's a last minute glitch. If you look at as discussed in the introductory part of the session, the maximum rate of surcharge has been reduced to 25% from the current 37% under the new regime for individuals, bringing the maximum marginal rate to 39%. On the other hand, the government has increased the burden of taxation on elite class of individual taxpayers by taxing high-value insurance policies, market-linked debentures. MLIs, I can tell you, was a very, very key planning tool for high-net-worth individuals, and capping capital gains exemptions for residential houses on long-term capital gains income. Now, Gautam, my question to you is there any balancing act done by the finance minister by giving some goodies of surcharge reduction by somewhat compensating the loss to the exchequer through other avenues of widening the tax base for the elite? What's your view on this, Gautam?
Yeah. See, Aditya, this is not a very new phenomenon, because we are seeing throughout the years, it is a very common practice of the government that in one hand they give, on the other hand they always take. So this balancing act, persons who are following the budget very carefully, or even common people, they, as and when the final points gets implemented, they can feel that no, at one side they have given, on the other side they have taken. However, we should also remember one thing, that this reduction in surcharge is a recurring phenomena for each and every year, which they will enjoy for, until and unless this is once again increased. But
Correct.
The capital gain or the insurance premium more than 5 lakhs, now the total income will be taxed. These will happen only in the year when there will be a capital gain or the policies will be mature. So I think these, keeping in mind, so all in the value perspective, if you see, yes, there is a balancing act. However, if you see from the viewpoint of the assessees, the HNIs,
Yeah.
they will be benefited.
So you feel that there will be an overall benefit coming to the high net worth individuals? Because
There will be, because each from 23-24 onwards, the financial year, they will have a substantial reduction in their tax outflow, because the rate of reduction on the effective tax rate is going to be 39%, which was 42.75 almost. So that difference on the HNIs who are earning more than 5 crore will be, substantial.
I'll just put it in a number way. Between individuals earning between 15 lakhs to 2 crore, they have a saving of around 50,000, 55,000 of disposable income. People earning between 2 crores to 5 crores, not much of a benefit. But then again, earning above 5 crores, we observe the savings could be as high, and as Basant was showing his examples, as the income increases beyond 5 crores, the savings were running into lakhs and lakhs and lakhs of rupees.
Yeah.
So the 2 to 5 crore income bracket, somewhere they have been disadvantaged. They have not got the true juice, the benefit of this. Eventually, with the, beating the drum, Nirmala Sitharaman, the Honorable Finance Minister, she kept on saying one thing, that I'm going to lose 38,000 crores, I'm going to lose 38,000 crores, I'm going to dole out 38,000 crores. Well, I don't have the maths of it, but somewhere this money is going to go away. But is it that 55,000 where it is going, or is it the high net worth individuals? That split is not provided anywhere. So are they going to lose out on the high net worth individuals at 38,000 crores they are talking about? Where that 42-43% tax rate is coming down to now 39%, that 4% delta, is that loss because of that 4%, or is that loss because of that 50,000 which they are paying to all individuals between 15 lakhs to 2 crores, that 55,000. So it's a number game, we don't know, but yes, they have been smart enough. Everyone looks happy, but I know, Indians generally have a thought process of saving. Many of them are still going to continue in the old regime. If I look at the lower income brackets, 15 lakhs, 20 lakhs and those income brackets, they're not going to move into the new regime and enjoy that 55,000, rather they'll be putting into ATC and all other savings and HRAs and everything and trying to still save that money. So, I've been hearing from people, it's an eyewash. But yes, I think so the concrete benefit is definitely there to the high net worth individuals who are above 5 crores.
Yeah, provided they opt for the new regime.
No, for 5, they would naturally, Gautam, because the gain is so high, you would definitely opt for the new regime.
Definitely, yes.
Okay. I'll move to the next question. The intention to make the new tax regime for individuals more attractive is clearly depicting from the recent amendments carried out in section 115 BSc of the Act, such as change made in the applicable slab rates, enhancing the rebate of 87A and allowance of standard deduction under section 16, leading to additional cash flow in the hands of the individual taxpayers. The new regime does not provide any investment-linked tax reduction under 80C except for deduction under 80CCD2 and 80JJAA. Arun, Gautam, initially I'll ask Arun this question. Do you see that the government is disincentivizing small savings and investments by making new regime more attractive, more and more attractive? It was not at all attractive last year. Not many opted for it. Well, they have created an arbitrage now, but the arbitrage still is not so much in favor. But the gap which was there between the old regime and the new regime, it's dwindled now, which does not provide for deduction of insurance premiums, small savings. Arun, what do you say?
Firstly, I would like to thank the Bengal Chamber for the opportunity to present my views. Yes, 115 BAC, the new regime, like Aditya mentioned, there were not many takers. So it's been available as an option for about 2 years now, and there are not many takers, and the government is trying their best to make it attractive. What is more scarier, if I may say so, is this being made the default regime. So what does this mean? Does this mean that there is a sunset around the old regime? Is that the direction in which the Ministry of Finance is thinking? That's a question for another day, but that's something we need to watch out for. But certainly tax inculcated the habit of savings. That's one thing which people looked at. People looked at elements like FDs, elements like ELSS because of ATC benefit. Now that's taking away that is probably going to take away the habit, especially amongst the Gen Zs, because that's something the Gen X and Gen Y grew up with, savings and tax benefit on savings. So directionally, it seems that widen the base, no exemptions seems to be the thought process. But we need to, like you mentioned, Aditya, one has to do the math for each case. It's, one side we talk about ease of doing business, but we give two different options and each one has to elect this every year. So it has become a much more complex exercise than what it was as a simple, I do my FDs and I give the FD receipts. It's no longer that. So it becomes a complex exercise both for the company as well as the employee, company from a TDS standpoint and employee for electing between the new regime and old regime. To sum up, yes, one will have to watch out to see what does this default tax regime mean, and is there like an annual election form that one needs to file because you are opting out of a default.
Thank you, Arun. Gautam, you want to add something to this?
Yeah, I want to add here. See, today only I was reading the interview of our Honorable FM in Business Standard. It is very clear from her words that now the government wants a very simple and exemption-free tax regime. To do that, and looking at that viewpoint only, they have made it a default regime. As Mr. Arun was concerned that whether we'll have to opt or not, they have also introduced another subsection. For that now, instead of opting for the new regime, we'll have to opt for the old regime. Because the default regime is the new regime. Now, thing is that till date, although they have made it much, up to 7 lakhs they have exempted, or they have concised the slabs, whatever, up till date, the old regime is by and large beneficial to the common man. Unless and until the income of any person is within 7 lakhs, more than 5 lakhs, and he or she do not have any investment other than ATC. Now, what I am trying to say is, what I feel the government will slowly make it more attractive, not by bringing in exemptions in this new regime like they have brought standard deduction, but what they will do, they have to increase the slabs. Unless and until this 15 lakhs, over and above 15 lakhs 30% rate is increased to over and above 20 lakhs 30% rate, a large number of SSC will never opt for this new regime.
No, I get your point, Gautam. But Gautam, if you go to a fundamental question, and which Arun also highlighted, since I've been earning money 20 years as a professional, since Arun you have been earning money, savings was incentivized by the government.
Correct.
Right? Finally, they are doing away with that. That phenomenon is dangerous actually. And
very dangerous.
Highlighted by Arun.
Very dangerous.
So, I don't know where are we heading. This is something which was a good phenomenon, you're incentivizing savings in the people, and that goes in the long run, but somewhere, because ups and downs, lows and highs that keep on happening, but that incentivizing, you were forced and pushed, you were incentivized, but that's going to be missing. And not knowing, is it the correct way the way government is going? They wanted to boost
what my greatest fear, I want to add one more thing, Aditya. What my greatest fear is, now LIC or insurance is for security for future. Now, my greatest fear is they should not bring the EET in the next year or in the subsequent years for the retirement funds. Because slowly they are discouraging investment which are required for our security purpose.
Yes.
In a country like India, this will be absolutely disastrous.
Well, if you see, they are actually plugging everything, step by step. They got into the EPF last year, they got into everything. They're getting into each and everything slowly. So I don't know, they are disincentivizing and leaving savings to your conscience actually, rather than, the government wanting you to do it. Nevertheless, I think so this is a question we can keep on debating. I'll move to the next question. And this is my last question on personal taxation. The timely and expedite disposal of pending appeals has always been a matter of concern before the ITAT, Income Tax Authority, sorry. In order to achieve the same, a new authority of appeals, namely the Joint Commission Appeals, has been proposed to be created with an object to dispose of cases involving small amount of disputed demand. Do you think the creation of JCIT appeals will actually ease out the burden of pending appeals, or an amnesty scheme for small taxpayers would have been a better purpose. My question is to Suresh.
Yeah, hi. So, first of all, thank you for providing the opportunity to Bengal Chamber of Commerce and to Dhruva. So, in my view, definitely, if you seeing the pendency of appeals what we have today and the kind of numbers which are increasing on a daily basis, definitely will ease out a burden a bit on the existing setup, and we can expect disposal of the appeals. But however, if the question is linked with the amnesty scheme for the small taxpayers, that would definitely would have been a better option, because that would have plucked the low-hanging fruits, and wherever the amount involved is not that much, or the things would have been settled at a faster rate, then we would have seen that all those appeals would have not been gone before the JCITs and all those things, and the burden on the existing system would have been less, and the quality would have come out much more better. So that is my view on this.
Yes. Arun, your thoughts on this? A minute of your thoughts on this?
Yeah, so I would agree with the view on amnesty versus increasing the jurisdictions or the authorities for appellate, because at the end of the day, you may not be resolving the appeal at JC level, especially given the experience with VAT, given the experience. So we have something similar in the VAT law, where there was a joint commissioner who was also an appellate authority, and it invariably ended up to be pro-revenue. It did not reduce the appeal numbers, it did not resolve the issues. So purely from, if you want to look at closure, if you want to look at settlement, amnesty would have been a better preference. But I would still welcome the JC just to keep the cases moving. It is at this point stagnant. We don't see many cases move at CIT appeals level. It takes much longer than ITAT, which is surprising.
Yes.
So that way, it's a welcome move. At least there will be less burden on the system, and we'll see some progress.
Yeah, Arun, I would look at it this way. It's at least there will be a more faster way to move to the tribunal, which is a good forum and a quicker forum and a better redressal forum.
Right. Absolutely.
Now coming to corporate taxes, to be honest, I would have framed 8 out of 9 questions on corporate taxes, but somehow the changes on personal income taxes were such, I could not resist putting up some questions, because all of them are from the corporate tax fraternity. Now to the question on corporate tax. In order to protect the MSME sector from delayed receivables from the customers, the government has proposed to disallow deduction for payments made beyond prescribed timelines on a permanent basis, mind you, in the hands of the MSMS customer as a 43 item. Unlike other payments of 43B, payment to MSE are not allowed even if paid before due date of tax return, and would be a sunk cost for corporates having MSME vendors, discouraging MSME vendors. With the restriction under 43B for micro and small enterprises, where internal checks and SOPs need to be developed by your company, or would there be some reluctance in engaging with micro and small medium enterprises henceforth? Suresh, this question to you.
So
you have a lot of interaction with small vendors.
Yes.
So how would
So we have right. So we have in Tata International, we have very small vendors for our leather businesses, for our bicycle businesses, and so we have the various vendors. But as for we already had a robust systems. We already have a tagging systems in our various ERPs where MSMEs are duly have. And as a responsible Tata Group, we ensure that all those MSMEs are paid on time and there is no overruns on that part. So personally, this is more coming from, if I interpret it correctly, more from those times of 2020 and 2021, where the most of the companies defaulted in payment to the MSMEs, and whole MSME sector got into distress on account of that. Whole cycle got stopped because the payments were not coming. So this is more to do with that. So there can be some reluctancy in engaging the MSMEs by the firms who don't have the working capitals and don't have to pay to them. But I would say this is this step would at least ensure that it would compel them from a statutory perspective to make the payments and then only to claim the deductions. So I personally, I welcome this particular step.
So Suresh, being part of the Tata Group, the pinnacle of corporate governance, this is already a tick the box which has been completed. And if I ask this question to Arun, which is another Tata Group company, Tata Global Beverages, Tata Consumers, or the Tata Tea, which it's been known as today, it's known as Tata Consumer Products. So Arun, you would say a ditto or any different?
Ditto. It's not very different because yes, there is a level of compliance that is enhanced now, but it is unlikely that we would default on MSME payments because there's a statutory disclosure in the annual report, etc. So we don't see this as a dampener really, but taking a wider perspective, it creates one more layer of additional compliance, additional watch out. Yes, mindful of you want to protect the MSME. I understand the intention behind it, but the special status could boomerang sometimes.
Gautam, any closing statement on this?
See, I am more or less in agreement with Mr. Arun and Mr. Suresh. But one thing I want to add is that internal checks and SOPs or identification of MSMEs are already there because there is a reporting disclosure requirement in our financials. For 43B purpose, I don't think that will make much of a difference other than increasing in the compliance part because we will have to report it. We have to report it in the 43B. We have to keep a track out of those whatever has been paid the next year. But it will be rolling, because in the current year it will be disallowed. In the next year when it is paid, it will be allowed, provided it is not paid. However, as a company, I don't think there are much companies who keep...
Gautam, I would just want to correct, this is a permanent disallowance. Here it's a little different.
Okay.
So beyond prescribed timelines, this is one particular where it is a permanent disallowance if it is not paid within the prescribed timelines.
Okay.
Vis-a-vis the other ones. That's why that's the difference. So that's the pain which is there.
Yeah. So then, of course, compliance part will increase a lot, and we'll have to give
a tax cost. It's good.
It's a tax cost. Then we will have the compliance part will of course increase a lot. We'll have to keep a close check, but for our company, I can say for MSMEs, we do not keep it pending.
So that corporate governance is in there. You are a listed company, the Tata companies, I'm sure all of, but yes, but for the other mid-sized players who are dealing with the MSMEs, it's something, then it's a cost. Maybe a discouragement also in some way. But yes, corporates like you all who are already the pinnacle of corporate governance, this will not be so much of a challenge. You are already covered it up well in your internal corporate governance policies.
Yeah, and the interest portion is also now disallowed under Income Tax Act. So no companies will want to increase their disallowances.
Yeah. Thank you, Gautam. I'll move to the next question. Up to now, shares issued to residents alone were taxable in the hands of the Indian company if the issue price exceeded its fair market value. The scope of this anti-abuse provision of section 56(2)(7)(b) has now been extended to cover non-residents as well. How the amendment made in section 56(2)(7)(b) of the Act will impact the valuation of new age startups seeking funding from overseas investors, and we will see realistic valuations in non-resident funding. How do you see this impact the FDI inflows in India? Arun, your comments on this?
So this is an interesting amendment. Will this impact FDI inflows? Probably not. I'll tell you why. The way 56(2)(7)(b) is worded, they talk about a valuation, and there is a valuation ceiling, upper ceiling, as far as 56(2)(7)(b). If your issue price is higher than the FMB, then the excess is treated as taxable income in the hands of the company issuing shares. FMB for this purpose, for 56(2)(7)(b) alone, is linked to, the rule gives an option of either DCF method or the NAV method.
Yes.
So the flexibility has been built in, and most commonly used mechanism in startups has been DCF. So otherwise also you can, DCF is so fluid as a valuation system, you can demonstrate the pricing. Additionally, 56-70 excludes VC funds, if I recollect correctly. It excludes VCs.
Yes.
So the flip, there was also a flip, 56-10, which was talking about taxation in hands of investing companies.
Yes.
Foreign companies were always covered under 56-10. So this pricing guideline was always there. For RDA, again, FEMA guidelines have pricing guidelines as well.
Exactly.
But
So
it's
you
a
need to
floor
marry the
price.
two guidelines, the FEMA guidelines, which again
It's a
speaks
floor
of a
price.
fair market value, which is DCF.
Yes.
So Arun, I feel what is happening is the room which was there between the NAV and the DCF for an investor coming in, that room gets plugged. Now it is just a DCF or the fair market value, because FEMA is saying fair market value. Here, fair market value, which is a NAV or a DCF. Therefore, I'm just getting myself restricted if I marry the FEMA and this provision. So any foreign investor coming, now I'm getting stuck into one single price point instead of the range which was there. So
Absolutely, that's how it comes across.
I don't know, there should have been some amendment to the FEMA regulation also, but I think so FDI regulations is long overdue amendment. We've seen an ODI amendment in the September of 2022. I believe they also create that range. Then the two regulations, the FEMA and the income tax, they marry together well. Because right now, FEMA restricts you to a point, income tax gives you a range, but then when you marry them together, you get to a point. You don't come to a range again.
Correct, there's no range, because and FEMA
Which is
a,
not good, which is not good for any FDI.
FEMA is a floor price when you're issuing shares. FDI has a floor price. DCF is a floor in FEMA, and DCF is the upper ceiling in income tax. So
what
DCF is the only
the
price.
ceiling for one is the floor for the other. So it is just that single point. So there is an anomaly when you marry the FEMA and the income tax. That is something I think so the government should be conscious of, and either amend the FEMA, FEMA regulations on FDI, or make a change to this, see how the two marry together. Suresh, you would want to add something to this, or you feel you have covered most of it?
No, I think only one thing to add today, even irrespective of the resident, non-resident, today the gaps of the 56-10 and 7B in terms of the investor and the investee perspective, the gaps are there. One side they say NAV, second side they say DCF, or those kind of things. That struggles even established corporates also have. And as far as the second thing is concerned about the dampness of the FDIs and those kind of things, I don't think so. Okay, all these valuation guidelines have those FDI impacts, because whatever the investments which are coming in is coming for the value per se of the whatever the ideas the startups are having. So if the ideas are continuously going to be good for the startups by the startup ecosystem in India, I don't think so this will have much of an impact on that.
Thank you, Suresh. So we will move to the next question. This one, yeah. Now, on IBC, very interesting. Basant touched upon it. IBC acquisitions see a massive haircut where financial institutions realize only a small portion of the dues, and most of the claims on the corporate debtor are finally waived under the insolvency process. Such settlements with financial institutions are low amounts, provide a benefit to the successful buyer, as there is no further loan obligation to be settled beyond the bid amount. The budget proposals seek to tax such waivers of loan obligation being in the nature of benefit of cash, upsetting the Supreme Court ruling of Mahindra & Mahindra in this matter. Will these amendments in section 28(4) on benefits of purchase in cash, will that be a spoil sport for companies eyeing acquisitions under IBC? Arun, what do you say on this? I know Tatas have been always on the prowl for good acquisitions, so...
Right, this is again, I think it's a old habit. We try to plug one issue with an amendment, and the amendment language is so wide that there are collateral damages, and this is one such collateral damage, I suppose. The background is clearly 194R, the TDS section on benefit and perquisite that came out.
Yeah.
Because 28(4) was always in the Act. There was no requirement to amend it to say cash or non-cash. It was 194R which created this confusion. Then they followed by a circular which further created a confusion, clarificatory circular which further created some confusions. Now the amendment is to say that whether the benefit is in cash or non-cash will be treated as a perquisite of benefit for both income purpose as well as TDS. interesting thing, similar clarification has been brought in 194R. That clarification is effective 1st April 22. But the clarification in 128.4 is effective from 1st April 23.
Yes.
So what happens to the 1 year? It's not income but subject to TDS, is it? That's how it seems to be the interpretation. But IBC, I think some clarification would be expected. Otherwise, IBC would become less attractive. That's probably not the intention. I expect some clarifications to come through.
So you feel this was not intended to cover that, I will not call it a benefit, it was a natural, unsaid rule that I'm acquiring an IBC asset, there's a loan waiver, that should not become income. So it was sort of an unsaid rule which was there. You also feel that the government didn't intend to plug in, but as you rightly said, it was 194R was the target, this is a collateral damage. So Suresh, your thoughts on that?
Sorry, if I may just add, even in IBC, the question is, okay, if there is a waiver, it is taxable in the hands of which entity is another question. Probably if it's a share purchase, then it sticks to the company and then it comes through. Yes, definitely something to watch out.
Yes. Suresh, your thoughts on this?
So I agree with Arun, and only one thing to add what he has already said. See, you cannot tax each and everything, otherwise the whole purpose of this IBC will fall through. You cannot tax, like whenever you find anything, you can tax that. You need to give some headroom, otherwise this IBC whole things will fall in. So otherwise why somebody will come, because if he knows that whatever the benefit he is going to have, it's going to be taxed. So it should be seen separately from the other acquisitions where you already have the valuation mechanisms and those kind of things perquisites, and so it should be seen from it should not be seen from the same lens. That's only.
Yes, I completely agree with you, Suresh. That's not the intended. Something on charitable and religious trusts. There have been 2 Supreme Court rulings we have seen in the last 6 months. They have unsettled the settled positions. Question now on the issue which was non-contentious has become contentious due to Supreme Court rulings, and a spate of amendments we have seen in charitable institutions, the taxability of charitable institutions in the last 3 years. And if you look in every budget, the past few years, that the provisions governing the taxability of charitable and religious trusts have undergone sizable amendments. Do you think there is a factor of mistrust on trust with recurring amendments? Is what's happening? 3 years, I think 2 consecutive years there have been amendments, 2 Supreme Court rulings. What's happening? Is there a mistrust around this? Or the government is going overboard? Arun, my question to you again.
There is mistrust, and there is a reason for mistrust as well. Because this is one area which there have been cases of abuse, and it's been published and it's been spoken about. So there is a mistrust, and for a reason. Yes, the government is strengthening the norms. The government is trying to look at ways in which this has been misused and trying to address it. Even the amendments you see now, it talks about transfer from one charitable trust to another charitable trust, whether it should be considered as contribution, should it be considered within the 85% of money spent. It talks about merging 2 charitable trusts. So it doesn't, if it's a pure play charitable, sorry, your interest is still protected. It is still trying to cut those edges which are gray element. So we broadly are, if you are in the green, if you are doing a genuine charitable activity, you would not be concerned by these amendments. But the amount of compliance because of what has been happening around with the kind of amendments that are coming through, one has to demonstrate a lot more than what it used to be a couple of years ago. I only see a compliance burden, but I don't see the principle being vitiated here.
No, Arun, my question to you is, if you look at the 2 Supreme Court rulings, did you feel that they went overboard?
You may say so. Again, did it fundamentally shift anything for a charitable trust in the way they operate and claim the benefit? The answer was no. So yes, there will be some element of business in a charitable trust. You pay tax for it, probably get a GST registration. Those elements are there. How do you allocate your funds? What is corpus? What is general donation? These elements of judgment continue to be there. They are not fully addressed. But yeah, at a principal level, I still see the charitable purpose and the tax exemption being protected.
Thank you, Arun. That was quite a diplomatic answer, but I personally feel that the Supreme Court has gone overboard on that. It's very difficult that if I have a profit component of X percentage, therefore I'm doing charitable, but if I have a little higher profit component, I think so you're trying to contain something. If it's the word general public utility, that's been split open and I don't know, it's been mashed up somewhere. I think so they've gone overboard. That's a personal take on that ruling, but nevertheless I was expecting that the government would come and give some clarity on that in this, but they were just silent on it. Now this question is open to all of you. Do you think, so Arun, starting with you again, what's the biggest miss you feel the government has done, they should have brought it in the budget? Two of them.
One, clarity around the TDS sections. Last 3 years, they've introduced quite a few new TDS sections. If you supply goods, there's TDS, but there's also TCS and things like that. So there was some clarification expected, or at least relaxation, because the compliance burden has increased significantly. That was one expectation. Second, there was an expectation on indirect tax front, an amnesty scheme on indirect taxes, because there was an amnesty scheme for direct taxes, there was an amnesty scheme for VATs, which states came up with, and service tax. There was nothing for customs. So there was an expectation of an amnesty scheme for customs, which did not come through. It was quoted in the newspapers, widely spoken about, but somewhere it did not see the light of the day. These were the two things which I felt could have found place in the budget.
Gautam, your wish list? It didn't get attended.
Yeah. See, I personally felt that the government would extend the sunset clause of 115 BAP, which is ending on 2024 31st March, to another 1 year or a couple of years. Being this the one. Number two is the government has withdrawn the extra benefit or extra exemption on the R&D expenditures in-house from March 2020. Now, when the government in the last couple of years or even 4 or 5 years, they're harping on Make in India, Make in India and Make in India, these are the benefits they should have extended to the manufacturing companies. Especially this 35-2AB, which was completely withdrawn or stopped with effect from 1st April 2020. Either similar exemption or that should have been extended.
Suresh?
And yeah, another one point which Mr. Arun has already told, and I am completely agreeing with that. 206C1H, first they have introduced, then they have introduced 194R, before that another TDS on the same transaction, TDS and TCS. They should have clarified that. And 194R is a complete disaster. Not the section, the circular, which is supposed to be clarified in the nature of clarification. That is creating much more confusion.
Suresh, anything more you would add, or do you feel you're...
Yeah, so I echo the confusion which is there around the TDS part. There should have been a bit of clarification. And apart from that, on the indirect tax front, we personally were expecting something on the ocean freight, for which we have a Supreme Court decision also, and we were expecting something, because today even if you go to any of the states, any of the commissioner they see that we don't have any instructions or any clarifications from the government what to do with the applications of the refunds and those things. So there is nothing with them, and we still will struggle with, and we will now see to the council if they issue anything. We were expecting some sort of PLI announcements, especially for leathers and those kind of things, which was a bit of expectation, which we didn't came. So apart from the TDS, these two specific things which we were looking for, and which didn't came. So let's see how it goes now.
We don't get it all. Let's wait for. So let this government come back, or a new government come in. Let's hope they hear our voices. We'll keep taking representations jointly on this.
Yeah.
So thank you, Arun. Thank you, Suresh. Thank you, Gautam. Great interacting with all of you. Thank you.
Thank you, BCCI, and thank you, Dhruva. Thank you, Aditya, especially. Thanks a lot for giving this opportunity. And pardon me for not being present here physically at BCCI, because as you all know, that these are the couple of days when we as a tax department are very important. At least 2 days. Very sought after.
Thank you, Gautam. Thank you, Arun. Thank you, Suresh.
Thank you.
Thank you. Thank you very much.
Thank you, Mr. Hans. For technical reasons, we can't do what we have been doing for the past 2 sessions. We can't hand over mementos because nobody is physically here. So we skip to the next part, which is the next session and the final session of the day, which is a panel discussion on Union Budget 22-23. We have industry leaders participating in this panel. Mr. Hans, again, as you can see, is there with us physically. Rest of them are with us in a virtual platform. So we have with us Ms. Richa Sen Debgupta. She is the chairperson, Health Committee of the Bengal Chamber of Commerce and Industry and Chief of Strategy and Operations, Fortis Healthcare Limited. Madam, if you could hear me.
Yes, please, I can hear you.
Okay, AV team, can we see her? Great. Okay, I asked for 1, I got 4. All right. We also have Mr. Nitin Jain. He's the co-chairperson of the Manufacturing and MSME Committee of the Bengal Chamber of Commerce and Industry, and also Managing Director and VP India and Southeast Asia of Vesuvius India Limited. Mr. Jain, good afternoon. Welcome.
Good afternoon.
Thank you. You can see us and hear us properly?
Yes, very well.
Thank you. Then next we have Mr. Atul Tatia, Executive Director of GPT Group. Mr. Tatia, good afternoon.
Good afternoon.
Okay. Your audio and visuals are clear?
Yeah.
Okay. Mr. Prakash Bachawat, Director, JB Group. Mr. Bachawat, good afternoon.
Good afternoon.
Great. So we are all set. I leave it to Mr. Hans to take it forward.
Hello Nitin, hello Richa, hello Prakash, hello Atul. I'm so sorry we got delayed. Again, we have a long event. And this is probably the 4th session which we are doing since morning, 5th session actually. So sorry for this 20 minutes delay. So I will start my first question, which will revolve around infrastructure, investment in infrastructure and core industries. And to put the question, the perspective of the question right, I will also run a small slide deck of probably 2-3 slides, to just set the context of my question. Yeah. Now, an increase in investment demand has emerged as a powerful stimulus to industrial growth, and it has been triggered by a jump in the capex of the central government in the current and the previous year as compared to the pre-pandemic years. It's worthwhile to note that the investment announced in the manufacturing sector during the April-December 23 was 5 times the corresponding level in financial year 20. The surge in investment is also attributed to the policy actions taken by the government over the past several years. And this is something which is reflective out here. If you see in H1 of 22, there's a spike vis-a-vis the H1 of 23. 23, there's a spike. So the spike continues. And these are the core sectors if you look at. Now,
In the next positive indicator is the consistent growth in the 8 core industries of coal, fertilizers, cement, steel, electricity, refinery products, crude oil, and natural gases. The growth in these industries have been steady, reflecting of a broad momentum in the industrial activity, which is very much reflective of in the graph. There is an increase in capex. The private sector has received continuous support from centre's capex-led growth strategy of recent years. From a level of 3 lakh crore in 18-19, the centre's budget on capex has been systematically going up and reached 7.5 lakh crores in 22-23, and announced to be, it has already been announced, it's going to be 10 lakh crores in 23-24. Huge capex spend can be observed through development dedicated programs of road connectivity, port infrastructure, electrification, railways, and all of this. Again, if you look at the steel sector, it plays a pivotal role in crucial sectors such as construction, infrastructure, automobile, engineering, and defense. Over the years, the steel sector has witnessed tremendous growth. However, the worrying concern out here is the growth in steel production is largely driven by domestic consumption vis-a-vis exports. In this context, with a sense of optimism all around, my question is, and it's a little longish question, so far the outlook on investment in infrastructure and core industry has been upbeat. The recovery is due to 3 major factors like release of pent-up demand, surge in exports, increase in government capex. Of these 3 factors, it is acknowledged that the pent-up demand has a finite life. With global recession setting in, exports may not be able to keep up to the growth pace. Couple of worrying signs have been the two-wheeler sales witnessing lowest sales in the last 10 years. Household financial savings plunged to 3-decade low of about 4% of the GDP, which is at half when compared to private savings of pre-COVID year, that is 1920. If savings go up by pre-COVID level, it is likely to slow down private consumption, which may limit private investment in return. You just cannot go ahead with capex, there have to be private investments as well. Further, developed nations central bank have gradually been withdrawing the money they printed and pumped post-COVID to revive the economy. With shortage of money in the system, global inflation likely to remain high, which shall again impact Indian exports. In wake of these worrying signs, do you believe that the government has done enough in its budget proposal to keep the private investment upbeat? Capex, yes, but for private investment, have the initiative been enough, especially in the infrastructure and core industries? Mr. Nitin Jain, I might pose this question to you first.
Well, thanks Aditya for this question. To start with, it's never enough, right? We would like certainly always to have government do more. But that being said, I think there are some positive signs. To start with, I think the government tax collection has been quite positive. When we look at the graph that we have shown, the government spending on infrastructure has been increasing steadily and quite aggressively. The third element, we look at being the last full year budget, government has not really gone in the direction of populist budget. They have been quite measured in terms of further investing in creating capacity, whether it's infrastructure, talk about railways, and then on the demand side, the tax cut that they have done for the citizens, that should help creating extra demand. Now, that being said, this infrastructure spending has a multiplier effect, right? So it creates capacity for the economy to compete better. It creates demand for the raw material, whether it's steel or cement. It creates jobs. Now, from a overall macro level perspective, I think it's quite positive what government has done. As I said, we would like to see more. Some of the challenges that I see where government can certainly do more is on policy, if I can use the word flip-flop. We had in 2022 a challenge of export tax. There were some right reasons to do it, or I can understand the reasons why government did it, but it had some detrimental impact in terms of overall sentiments within the industry in terms of investment, and also impacted some of the export that India was able to pick on, especially on steel. So that would be a caution side of things where government potentially need to be very careful from a policy side. But overall, I believe it's very positive. and I'm quite upbeat that it should further generate demand and in the right infrastructure where it helps to increase capacity for the economy.
Nitin, every possible report across the world, starting from OECD to anyone, says that 23-24 will be a year of global recession. Indian government getting a wind of it has increased its capex expenditure to 10 lakh crores, probably to stimulate growth. It's self-inflicted or self-generated growth because there's more capex, there's more spending, more activities, more jobs being done, more employment. But that's the only thing which I can see. Is there anything more which, something which could pinpoint they could have done more for encouraging private investment? Because other than capex, every economist I am talking to, great about capex, but nothing more than something they could have done to the private sector. The PLI story is over now because what had to come has come already. People who had to jump into the wagon have jumped into the wagon. 115 BAV, I wish they would have extended it. That would have, incentivized people are setting up more manufacturing units, but it's going to come to an end next year. But still, I feel at a personal level, I feel there was more to, incentivize the private. They need to dig out into their reserves. They have a stronger balance sheet, and that's acknowledged by the finance minister.
Well, good point. As I said, I strongly believe that government can do more, right?
Yes.
That being said, as I said, the policy stability is even more important than, it's the first foundation. Coming back to again the point that I made, the flip-flop on export tax has been, just one example. There are many other examples from a policy perspective. The challenge it creates is that it breaks the sentiment. If you look at steel, which is one of the largest core industry, the type of investment that we have seen over the last few years has been unprecedented.
Yes.
And this is the industry which, number one, has some competitive advantage versus global other measures. You have the ore availability in India. You have domestic demand, which is looking forward very strong. And then you have potentially a lower cost base. But what happens with this flip-flop from a policy perspective, that it creates a, let's say, split breaker in the sentiments. So even though government has quickly came back and it has been removed, and I believe it's just a wrinkle, not a challenge, but we just got to be very careful. That would be my I would say, demand from industry perspective that consistency in policy is important. And that's, I would say, the first foundation. And of course, as you highlighted, further on PLIs could be benefit. Skill development, where government has done something, it remains one of the largest opportunity, I would say, in terms of creating capacity in the economy. So that would be my comment, Aditya, on this.
Atul, any contrary view, or do you concur with the view of Mr. Nitin?
Thanks, Aditya, and thanks, Bengal Chamber of Commerce, for this opportunity. I think that government has targeted some industries, honestly, which were also part of the climate accord and the climate, the targets that the government has set out for itself. For example, they have targeted sectors like battery energy storage. They provided some battery gap funding there as well. In interstate transmission, they provided some, for renewable energy, they provided some incentives there as well. And they've also allowed some environmentally sustainable projects, which they have given some credit facilities and some other initiatives for the private sector to invest in them as well. Having said that, I think that in the current scenario, the last couple of years, the public sector was leading the investment, rightly so, because the balance sheets of the corporates were leveraged, and now they, like you said, they have much more stronger balance sheets compared to the previous times. So now I think it is the time of the private sector to lead it. What they could have done, which you highlighted, is that the manufacturing, the tax holiday or the concessional tax, the 115 section, which is sunsetting on March 24, they could have extended that. But I guess they've taken a call right now not to extend that. but my personal feeling is that that is going to get extended because this government has a system of coming up with some mini budgets. So we can expect some surprises in the before the election as well on this manufacturing, the sunset on manufacturing sector.
Atul, your family has been in the infra space for a long period of time. So this
Sure.
huge capex spending which has been there, which has been spoken about, is it actually on ground percolating to these infra companies like yours, or it's already, because the amounts they're spending is huge. So it's obviously it's going and spending balance sheets of the most of the infra companies, or that space is too crowded. How's it working out there?
So I think that our company focuses a lot on railways. So in this budget, if you see railway, the investment is targeted at 2.4 lakh crores compared to 30% less last year. And we have been a good beneficiary of that, especially for civil contracts for railways, for bridges and others, and also for road contracts. So I think that it is translating to investments on the ground. It is an industry which has a multiplier effect and is leading to a lot of job creation, and a lot of the balance sheets of the corporates are who have good relationships with the banks and the customers they are getting good contracts and they are able to execute on the ground as well. Today, I think I would hazard a guess, I think 2013 we were doing about 12 kilometers road construction a day, which is now at 37, 38 kilometers as per the union minister. So I think that's a tremendous jump in the last 7 to 8 years.
It has been. So I know whose balance sheet is trending. Moving to the next question. This is focused on healthcare because I wanted to focus on the other sector now. The private healthcare sector said union budget presented by Finance Minister Nirmala Sitharaman Wednesday was really good. But at the same time, requested the government to provide some incentives to charitable hospitals, focus on funding and incentive for doing telemedicine and research in remote areas. Launch of 157 nursing colleges will help in shortening the gap in students for nursing care. The initiative to eliminate sickle cell anemia is a welcome step. There was a major boost to the medical education and research. However, concerns were also raised of not increasing the healthcare spend to 2.5%, which was promised, or at least thought about. The allocation for healthcare in the budget is 2.1% of the GDP. Further, there have been no major benefits from an indirect tax perspective to the healthcare sector, which was actually wanting it. There are a lot of issues around GST credits in the healthcare sector. My question is first to Richa. In the light of the budget announcement for the healthcare sector, we would like to understand your thoughts on the following. Is the healthcare sector expenditure growing in proportion to its importance? What more was expected by the pharma industry and the private healthcare sector from this budget? With containment of unemployment and inflation, and that's the economic survey data which speaks about it, how will it impact the healthcare delivery sector? Richa, first this question to you because you're from Fortis, I think so who better than you can answer this?
Thank you. Can I have the question displayed?
It is,
Yeah, thank you. So I think, healthcare, we all understand that it's a basic for all of us, for whole of the country. But then last 2 years, pandemic has made us all realize that how important it is, right? So if you ask me that in proportion to the importance, has it increased? Not really. Because I think we all know that the expenditure that we do as a country is barely 2%, and this year budget also it says 2.1% of the GDP. That's surely not sufficient. Because if I compare with the developing countries, minimum that we look at is 4 to 5%, and some of the developed countries like US, which obviously I would say is in a much higher side, is around 16%. So you can understand what we are spending in our country, and of course the status is for everyone else to see. So 2.1%, no, it's not sufficient. It really doesn't meet our expectation. So that would be my answer to the first question. What more was expected? So you touched upon that reduction in the direct tax is something which we were expecting, because as you're aware that a lot of technology, when we talk about the medical technology, is actually imported in India, right? So while we welcome Make in India, but then we still have a long way to go. So some level of tax reduction would have helped the industry. And Also, other than that, spend is something which we have already touched upon. Tax reduction is something that has really not happened. So these two things I would say has kind of, failed us on budget part. Now, talking about the containment of unemployment and inflation, healthcare industry, if you look at it, it is one of the highest, it produces one of the highest employment because, it's a very human intense industry, being the service industry itself. So while the containment of unemployment has helped the industry, but the matter of fact is that, healthcare requires a lot of skilled manpower. Skilled manpower, not the one which can be trained on the job. So if I talk about the doctors, nurses, paramedic staff, they need to be qualified to be working in the hospital from day one. So one positive step I would say is that announcement of opening up 157 nursing colleges along with the medical colleges which they have opened from 2014 is definitely again is a positive step.
Thank you, Richa. Atul, you are the only other person from the healthcare sector in this panel, so definitely your generous thoughts.
Yeah, so I echo the views of Richa, but just to add a couple of points, I would say that I think that they could have done some clarifications of 194R because there's a lot of confusion on 194R with respect to doctors and what they receive, what they don't receive. The circular I think was more confusing than the law itself.
True.
And second, I think that GST reforms which you mentioned, honestly, I think that how the GST Council has been structured and negotiated and resolved by the Parliament, honestly, the Finance Minister no longer has purview on GST. It's now the GST Council. So to hope or expect that the budget would resolve the expectations of the healthcare industry, that is, I think, something you were hoping against hope, because honestly, you have to wait for the GST Council to resolve these GST input credits and whether healthcare would be taxed or not on GST. So we'll have to wait for the GST Council to take it up.
So Atul, your sector would have made appropriate representation, and do you feel they're hearing you, the GST Council?
See, honestly, I think that healthcare and education world over are not purview to indirect tax. It's an industry which is so-called socially, it's a social sector. So, honestly, I see in Africa or Europe or US as well, both these sectors are bereft of GST benefits per se, wherever it is applicable. So I think that the Indian corporates or the Indian healthcare sector are expecting too much to get GST input credits.
So, the first one who's saying that accept this is reality.
Yeah, that is the cost.
It's a cost. Good. Thanks for being honest on this. Very few people are so honest about such things. Great. Now moving to the next question, and this will be focused on the real estate sector. It's got the highest number of IBCs. There's been a spurt of growth. There is government's attention on luxurious apartments, what they've done under 54-54F. Have they killed the industry of luxurious apartments? Very tricky. Lot is there to talk about. This sector has witnessed resilient growth in the current year. The housing sales and the launch of new houses in Q2 of financial year 23 surpassing the pre-pandemic level of Q2 of financial year 20. Housing bank credit growth has also witnessed a healthy rise. There is evidence of a significant decline in the inventory overhang dipping to 33 months during Q3 of financial year 23 from 42 months last year. This comes on the back of sustained sales momentum in the sector and steadily recovers from the impact of the pandemic. Going forward, the recent government measures such as reduction in import duties on steel products, iron ore and steel intermediates will cool off the construction costs and help to check the rise in housing projects. The release of pent-up demand was reflected in the housing market too. Demand for housing loans picked up, consequently housing inventories have declined, prices are firming up and the construction of new dwellings is picking up pace. The National Housing Bank published two housing price indexes, namely HPI assessment price and HPI market quarterly, with financial year 18 as the base year. The HPI assessment price is based on the valuation prices of residential units collected from primary lending institutions. In contrast, HPI market price is based on the market price for unsold inventories collected from developers. And out of these, so what is the finding out of it? The finding is out of 50 cities, 46 cities registered an increase in the index, whereas 4 cities experienced a decline on an annual basis. Of all the 8 major metros, the country has witnessed an increase in the index. Now to the question, with this context, an element of optimism, an element of confusion, element of doubt, the question on COVID-19 pandemic accentuated a slowdown in the real estate sector, with there being project delays, declining property prices, reduced demand for office space because of work from home and migration of workforces to their native places. However, with pandemic receding away, there has been a renewed demand for both residential and commercial property, accompanied by low interest rates, reduction in circle rates, cut in stamp duties, and various other, not only one government, but many state governments have done that. Housing for all, Pradhan Mantri Awas Yojana, Smart City Project, and so on. Further, in Union Budget 2023, government has increased the outlay of PMAY by 66% and emphasized on the need to build green buildings. Recent geopolitical tensions between, now the contrary view, between Russia and Ukraine disrupted global supply chain, and consequent volatility in the international market has led to surge in price of construction material. WPI for cement has increased from 127.1 in December 21 to 137.6 in December 22. Also, the budgetary proposal of cap reduction, and this is something I just discussed, quite a dampener. Further impending worries of global recession stimulated by rising global interest costs brings to surface a question whether real estate sector is on the verge of impeding decision, and what notable steps could the government have taken to prevent such. Prakash, I think so, who better than you, who literally calls the shots on the real estate sector in the Eastern India market, comment on this.
No, so thank you for the opportunity, Dhruv, Aditya and Bengal Chamber. I think the question, was reading it sounds to be a bit more scarier than probably what I personally feel the reality would be. I do understand that, overall, the sector has seen a phenomenal growth in the last financial year, till now. And of course, after the COVID pandemic hit, where there was a lot of shuffling within the industry in terms of deleveraging, choosing the right product. Although the construction was slow, there was a pile-up of inventory, but overall, people had, from our industry, had become more cautious about, what they were doing. So there was a realization check, which was very important. Coming back to what I personally feel that, what the sector is right now going through and the current impact of the budget. Firstly, there has been a certain amount of change in the buying habit of a consumer. For example, one typical example could be that, a ticket size middle class apartment would earlier be 900 to 1100 square feet, but now we see that the increase has been more than 20%, so 1400 to 1500, which basically means that you have a lower number of goods to sell in terms of number of. The second part is that, when we look at commercial, for example, again, the work from home culture, most of the IT companies are still having it in force, but they still have a global requirement now of having a larger footprint per individual working. So it is getting pretty much compensated by that. So if there were 50 people working in a 5,000 square feet office, now they have 50 people in 8,000 square feet office. So then again, there is an increase in a particular demand over there. The challenge, overall, I think the budget, looks at the root part of the society when it comes to affordable housing, where there's a lot of importance given by reduction of direct tax. So you have a lot of disposable income now, people can invest in real estate or capital market, for example. The challenge I personally feel are three. One is that the GST. Currently, the cost on our, construction has really shot up due to the GST impact of steel and cement. We were earlier getting input credit, we are not getting it anymore. What we end up doing is basically increase the price, right? And if we increase the price, it is a direct impact on the consumer. I think that is one important reason. Even, we see that the prices have shot up across the 45, 50 micro markets you mentioned. We don't have any other option. If the raw material cost goes up and the GST impact is there, we do not have any option but to keep on increasing the price. The second part is that, on the builder's balance sheet, side, again, we are seeing an upside in the interest rate. So that will have an impact. Most of the leveraged balance sheet, and it is one of the leveraged sectors, will have a huge impact on their interest outflow. And that would translate into increased prices, which would be a double whammy for a buyer, because then, and on their home loan front, even they are paying higher interest rate. The other factor I feel, from the current budget point of view, is I think overall the gap between the central government, so we have to understand real estate is a very micro market game. There are a lot of things which are dependent on the state government. Budget is a central government thought process. Now, there are gaps over there. One major gap we have been fighting on the front of CREDAI is that, there's an act that says that we cannot sell less than 10% of the IGR or the market value. Now, the irony of the situation is that if I do that, I'm actually, violating an income tax provision. But there are state micro market areas where the IGR value is so high that it is not possible for me to sell at that value. Correct. So there is a huge challenge, right? Because there's a gap between information and data sharing. Now, if that is not corrected, or there's no corrective measure taken, of course there is a methodology, we give declaration, it is a very time consuming affair. Yes. So still the industry has certain challenges which I think the central and the state government have to kind of communicate better. But overall I think the impact, at least in the near short-term future within the country, if we have healthy projects, quality product, and the residential, I'm very, very personally bullish for residential as well as retail and warehousing. We do not see a major challenge, at least on the demand side. So if you are creating a good product, the consumerism is at all-time high in India. There's enough buying.
Because for it.
Yeah. So I think, to sum it all, I think.
Is this sentiment because you represent the JB Group and to some extent as one of the consortium partners to the South City Group, so which is largely focused on the Eastern India for the real estate part of it. So can I say, is it a sentiment of the East, a sentiment of Calcutta, or is it the national sentiment which you just spoke?
No, it is not. And, as I mentioned that, real estate is a very micro market knowledge domain, it is.
Eastern India and Odisha will be different from Calcutta.
Within Eastern India, even a Calcutta.
Will be different from Calcutta.
Absolutely. So, whenever, it is very difficult for a builder to say something which is at a policy level, because, what I'm mentioning, a gentleman in Gurgaon would actually rub it off against me, because, it won't make sense for him, because there the leveraging is on a different level. So, having said that, I think overall residential as a segment in India is to grow if you have the right product. There is no two-way about it. If you're making a right product, depending on that micro market need, you cannot go wrong per se. So that is a universal truth about, in my opinion, about on a very country level. But yes, you're absolutely right. Most of the point I will end up mentioning would be limited to this part of the country.
Great, thanks, Prakash. That's quite an enlightening discussion we had on this. I was always confused because whenever I met you, there was a sense of optimism, but then when I used to read the press, there was a different disconnect. So I used to get perplexed. But thanks for clarifying this. That's a very micro, rather, I think so. 50 kilometers away, the story changes actually. Why go 200 or 600 kilometers away? Okay. Now on the IBC, it's been catching a lot of news. 500 plus successful resolution plans. So a little bit of take on the IBC before I put up the question. The IBC code has facilitated an exit of distressed firms, thereby allocating scarce economic resources towards more productive use. Since the inception of IBC in 2016, 5,893 companies, corporate insolvency resolution processes have commenced by end September 2022, of which 67% have been closed. Of these, around 21% were closed on appeal or review or settled, 19% were withdrawn, 46% ended in orders for liquidation, and 14% culminated in approval for resolution plans. Sector analysis reveals that 52% of the ongoing CIRPs belong to industry, followed by 37% in services sector by September 2022. Further with the industry, 74% of the initiated CIPs were from manufacturing sector. Of these, textile, basic metals and food sectors accounted for 48% of the CIRPs. While in the services sector, 60% of the ongoing CIRPs belong to real estate sector. And real estate sector, that's where Prakash, this question will be posed to you. Now, if I look at this slide, overall in terms of value realization for initiators of CIRPs, the resolution plans realized 2.4 lakh crores, which is 177.6% of the liquidation value. A little higher, yes. And as per the RBI data of FY22, the total amount recovered by scheduled commercial banks under the IBC has been highest compared to other channels such as Lok Adalat, SARFAESI Act and the DRTs in the period. In this context, my question, IBC has resulted in over recovery of 2,50,000 crores over the last 5 years, which is more than the aggregate recovery of the other three channels. However, this value is still around 15% of the aggregate claims against the companies that underwent CIRP process. One of the reasons for such low recovery could be the dubious transaction undertaken by companies just before the initiation of the CIRP process. It is to be noted that only 64 crores has been recovered by the RPs by moving to tribunals to reverse dubious deals done by companies before moving to CIRP process. Out of the close to 2.3 trillion rupees of questionable transactions done by the companies. So the dubious transaction have been the hitch out here. Further, the average bankruptcy resolution time is around 679 days. That was not thought about when IBC was brought in. More than double than the statutory limit of 330 days. Delays can be attributable to slow progress in dealing with dubious transactions due to lack of clarity from the judicial president's absence of standard procedures and lack of dedicated tribunal benches. In light of the above, can IBC be still considered as one of the successful legislation by union government? What more can be done to make it more effective? Prakash, has your group contemplated or even explored, because what data suggests that what is under CIRP, a large part of it is the real estate sector. So what is your take on it?
So I think on a very macro level, Aditya, there is no two-way about it that, the sector in the last 10 to 15 years has suffered greatly in terms of non-performing assets and, companies going down under. And these are great companies, by the way, who were initially doing phenomenal work and, just because of probably some kind of a mismanagement or a wrong sort of leveraging. But, there's a saying, right? Something is better than nothing. Now, imagine if today nothing would have been there.
It's a locked-up asset. It's a locked-up asset.
Yeah. So I think overall, there is no two-way about it that the law and the legislation is something which is very important for the country. And, fortunately, this part of the country, East India, has seen very few NPAs. But if I talk about North, we have a bunch of builder fraternity friends, we keep getting insight. And, even buyers, and, I myself, I'm a buyer somewhere where I'm stuck. And, the apartment been more than 10 years, nothing is happening. There are challenges in it. I think one major challenge, if you personally ask me, would be that, no matter what amount of time, is taken, who will eventually complete the project. Now, there are government representatives put on board on few companies who finish a real estate project, which is pretty technical in nature. And these are not affordable housing per se, where, you purely just do the construction and hand over. There are a lot of things which have to do with finishing, right? And that is one major challenge because, the outlook of the team who is setting in, even after they come in after 5 years, they will take another 5 years to finish the project. There's a bunch of buyers who are not looking at delivery of apartment. Let's consider that, there's something which has been passed and there's a committee made, the committee is finishing the project. But there are a bunch of buyers now, they are not in a position because they have already invested a portion of their money into a new apartment. Now they don't want to, either they want a refund or they want to cancel the apartment. And then again, that becomes a challenge. But again, the fact is that in our country, it's a huge amount of money which is stuck, and these are buyers whose hard-earned money has been stuck. There is no two way that the act is something very critical. The normal logical thought process would be that there could be a faster sell where it can be done time bound, where projects are taken and the resolution done and the delivery done within a stipulated period of time. Yes, they have failed from 350 days odd. What they have planned, it has already been doubled up and probably it will be triple. But this is something very difficult to comment. How the law takes its own course of action, but I think there are a lot of challenges on the delivery side. Even once, as I mentioned, that the committee is made, which itself is taking a lot of time. The finishing of the project, just to give you one example, there's one particular project in Gurgaon where I am a buyer, and I have realized that after the committee has been made, it has been 5 years. And if I go to that project, there has been some development. I will not take away that, but a normal builder would have probably finished it in 5 years. So then there is a theory which, in CREDAI we were talking about, that how we can do actually public-private partnership. Now these projects can come to builders who can probably end up delivering, right? So we get opportunities to buy something in BIF, through NCLT. Again, it works both the way. But as far as I am concerned, it is something which is important, and there is no two way about it that it has to be speeded up now.
So probably, Prakash, I think there needs to be a marriage between the RERA and the IBC. Some way that marriage is not there. Atul, your thoughts on this?
Honestly, I think that it's too early days for India and IBC. We are hoping that we would be similar to a Chapter 11 of US overnight. Nothing happens in India overnight, and sometimes we as corporates are very unrealistic in our expectations. Having said that, I think that what has been achieved is a fabulous job, nothing to take away from it. And there are a lot of issues with respect to operational creditors who were earlier not part of the IBC. They have been partly made part of the IBC. So operational creditors are, in the earlier, I think, resolutions, the operational creditors got nothing. Now at least they're getting something. So I think the law needs to give them some benefit of the IBC as well. Everything should not go just to the financial creditors, because the operational creditors and the other creditors are literally, if a company goes under, they are getting nothing. So I think that's also not right in some sense, in the broader moral sense.
Matul, I'll honestly say you're very forgiving in nature to the government.
No, I think that I think that it's not the question of being forgiving in nature. I think that you need to have the expectation management has to be there, balanced. It cannot be a very high expectation. Expect everything from one budget or one government also, in some sense.
I'm with you, Atul. But I have a thought process. It's a generic thought process, not about IBC. Like if we start saying that in different countries they've taken 20 years to mature to a particular position, I personally feel that if India also takes that as a benchmark, that say a European country or a US or a Singapore took 20 years to start and get to a particular point, India with its size and population has to leapfrog. It cannot take that 20 years as a benchmark or a 10 years as a benchmark. Somewhere the way we have done with smartphones, somewhere we have done with banking, digital banking, actually it's a leapfrog which is there. So
yeah, but if you see the history of Chapter 11 in US, it's not 20 years. It's probably 50 plus years where Chapter 11 is in US, and IBC is a law of 2016-17. It's only 6-7 years.
Yes.
So it's not. I'm not saying that we should expect it to take 50 years, but probably a 10-year window is a good enough window for it to mature and to come on the same timelines as a Chapter 11 in US.
Noted, Atul. Thank you. My last question of the day, and this is with respect to reigning IPOs. And this question, I can tell you, will be first posed to Nitin because he's the only listed company in the panel, and it will also be posed to Atul, who's a wannabe listed company. So a listed and a wannabe listed. From April 2022 to November 2022, the buoyant performance of the primary market has been observed despite turmoil in global financial markets. Compared to financial year 22, the number of firms opting to list on the browsers increased by 37%, though the amount raised declined to about almost half of what was raised in the last year. Although the year so far has been lackluster in terms of fund mobilization through IPOs, the number of SMEs coming out with public offer have been quite encouraging. Compared to financial year 22 until November 2021, this year, not only did the number of SMEs coming with IPOs almost double, but the total fund raised by them were almost 3 times the fund raised by them in the same period last year. In April to December 2022, the global stock markets declined because of geopolitical uncertainty. On the contrary, the Indian stock market saw a resilient performance, with the blue chip index Nifty 50 registering a return of 3.7% during the same period. Nifty 50 with its valuation of 21.8 times the earnings of the constituent stocks price earning ratio on trailing basis at the end of the December 2022 is expensive compared to the global markets, though still lower as compared to its own last 5-year average. To the question, the Indian promoters have realized the importance to monetize the business through valuations and raising money through private equity investors, QIBs, general public. Last year also witnessed some of the big tickets listing, but companies failing to maintain the listing price thereafter. I don't need to name those stocks, but we know where there's been a diminution in value. In wake of global volatility and uncertainty, well, I think so. I read in the papers today, there was a revocation of a FPO today morning, or yesterday morning, I think so I read about it. We all know about it, not taking names. In wake of global volatility and uncertainty, what is your take on current scenario for companies eyeing listing of their shares in the market? Further, the outperformance of Indian stock markets have resulted in turning them expensive compared to their peer indices in China and Brazil. Do you think the Indian stock market will be able to maintain its performance and continue to attract global investors in near future? Nitin, please.
Oh, thanks, thanks, Aditya. It's a interesting question. If I knew the outlook on the market in terms of, I mean, longer term perhaps, but short term, it would have made me very rich. But anyhow, I think in a larger context, it's very difficult to compare different economies on valuation of the market. What we perhaps need to look at and believe in is the underlying capacity of the economy, right? So all the, I mean, if you look at consumer sentiments, right? You go on the market, you see the demand in airlines, the hotels, the restaurants, you see a lot of positive sentiment. You see the core sectors grow, they see positive. That's one element. Second element, we're starting on a very low base, right? As size of the population and size of the country, and the low base that we start with, I think there's a lot of potential for growth, for which you see, investment sentiments all across. So I would perhaps my comment would be more longer term basis, that there's certainly very strong fundamental strength in the economy, on which basis I believe the long term equity should do well. Now short term sentiments and it plays big role, so very difficult to comment. I believe a lot of promoters are sitting on a lot of good companies, which have a lot of value to create as the market and economic cycle picks up or gets strengthened. So there's certainly a lot of strong balance sheet and P&Ls which should come to the market. Now, short term, very difficult to comment. But I'm quite upbeat about overall economy, and I believe equity markets
will be reflective of the optimism which is there.
If anything, some indication. And then, lastly, the digitalization and ability to have access to the information and ability for people to participate in these markets, which are indicative of all the new demat accounts that you hear being open and continue to progress, and younger investors coming to participate in the market. I think it's a positive sign.
Nitin, I'll just share a statistical data, I read it somewhere, that only that 1% of the traders have actually made the money in the last 2 years. And those 99% other investors have not made money. So
That is in futures, not in normal.
not in futures. Okay, it's in futures, not in. Probably then I misread it. But Atul, you share the same optimism about the stock markets?
See, honestly, we as a corporate do believe that the market would be buoyant, but like Nitin said, there could be corrections here and there, and it also depends on a lot of external factors with even US Fed increasing interest rates as today morning or yesterday night, whatever you call it. And I think that the only drag could be potentially that the government is now less encouraging savings because of this more focus on the new tax, the concessional tax regime, so which doesn't increase the ATC limits. So earlier people were investing because of these SIP inflows, and I don't think that the SIP inflows are going to go up further too much, because if you are moving to a new tax regime, you don't get any extra benefits if you are investing in the market or you are buying insurance products or whatever. So the country will need to rely a lot of it on long-term money from FIIs. Now, how do you attract long-term money from FIIs is also a question of diplomatic relationships and also a question of political relationships. So I'm sure that the government is looking at some initiatives which will do it. Like you mentioned in your preface, there was a cancellation of an FPO, not to name names, but I think that speaks volumes about what could happen in the future as well.
Thank you, Atul. Thank you. Rishabh, would you want to comment or Prakash on this question? Keep it open to you, the two of you. Rishabh, you?
So I'll quickly say that yes, Fortis is also a listed company. We listed in 2007. Right, and as far as healthcare is concerned, the industry is very bullish. We have got a lot of investment coming in from PE, and even recently, whichever company, without taking names, have got listed, that's a large healthcare delivery company. They've had good response, so I'm quite positive about it.
Prakash, closing statement from you.
So for us as a family, we do capital market transactions. So of course, we are not a quoted company, but being an investor in equity market, we are a firm believer that, at least from our family perspective, we do investments mid and long term only. So short term trading, of course, is a great way to, if you are having a great hang of the market and, there are things which keep on changing. But mid and long term, what can go wrong with a country like India? I mean, it is by far one of the leading economies of the world now. And, there's such great companies coming in. And if you pick the right stock and, you're invested in the right manner, great.
Well, I think so. All of you are optimistic about it. So, good. With this, I would like to close this session. Thank you, Atul. Thank you, Prakash. Thank you, Nitin. Thank you, Richa. It was great talking to all of you. Just a closing note from your side.
Thank you, Mr. Hans. I mean, you've been staying put in the podium for more than 1.5 hours now. Yeah. So thank you for your patience and so gracefully and enrichingly taking forward the sessions and moderating it so well so that we can get the best out of the panelists and understand the nitty-gritties of the sessions or the contours of the sessions. So with this, as Mr. Hans already mentioned, we come to the closure of today's proceedings. We have lunch upstairs. We would request all the delegates to go upstairs and have your lunch. Thank you for being there today. We would have these proceedings, we were streaming this live in all our handles. You can go back and check it out when you have time in our official YouTube and Facebook channels. These proceedings will be already there. Thank you so much. Look forward to having you in other programs which are coming up. Thank you. Have a nice day. Bye.